Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj. So now this is part 2 of our CMA Inter Paper 12 Management Accounting Revision Marathon series. Now in this video, we will be covering 4 chapters: standard costing, your forecasting and budgeting, then your division performance measurement, and your ABC, activity based costing. Now let us get started with the first chapter in this video, which is standard costing. Right now guys, before we move into this particular the revision of standard costing, now let me tell you a few things about this chapter. Number one, this chapter standard costing is a common chapter between paper 8 cost accounting and paper 12 management accounting. But in terms of syllabus wise, in cost accounting, there is only very limited portion of this chapter, whereas in management accounting, the entire chapter, the entire concepts involved in standard costing is there. That is number one. Number two, now in this chapter, if you have attended a regular batch, you will definitely be able to appreciate the statement. This is the biggest of all the chapters in our CMA Intermediate paper 12, right? This is the biggest of all the chapters because we have done about 50 numerical problems, 50 plus numerical problems. You've covered it in our regular batch. Now, this being a revision lecture, revision marathon, what I will do is I will touch upon all the concepts involved in this particular chapter, right? And we will be revisiting all the formulas that were covered in our regular lectures as well as, right, that is there in your syllabus. We will be covering every single thing, right? And finally what we will do is we will do one full comprehensive numerical problem covering all the cost side variances as well as the sales variance. So this way it will be a super revision or what do you call, a very good way of touching upon all the major concepts involved in this particular chapter. Are you clear with this, guys? Right? So now one more thing I want to tell you before we enter into this chapter. In our paper 12 management accounting regular batch, I had asked you guys to prepare one full chart, right? Writing down all the formulas that we learned in this chapter, right? And I asked you guys to write it by yourself without mugging up logically. And remember, I also asked you guys to write that hashtag standard costing is logical and all of that, right? I'm happy to note that some students have done this, right? Now, if you have that chart which you have prepared, right, so you please have that with you right now. Anyways, I have prepared it for you guys, and a copy of this PDF copy of this will anyways be provided in the description below, right? So you can download it. But if you have prepared it, nothing like it. That is the best way to actually revisit this entire chapter. So now that is going to help us out. And we have also seen, I've proved it to you guys that not even a single formula in this entire chapter needs to be mugged up. Even in this revision marathon, I will be explaining all the logics of each and every formula in a very quick manner, because it can't be too much detail because this is going to be a marathon. Clear with this, guys? Fine. So on that note, let us get started with this beautiful chapter called as standard costing. Now, what is this chapter all about, right? Now, at the beginning of a financial period, right, a company prepares budget and they will arrive at the budgeted profit, which means what? The profit they are planning to achieve. Now, after the end of the period, now the company takes into account whatever is the actual sales minus actual cost, all these things, they will arrive at the actual profit. Now, the budgeted profit and the actual profit will definitely not be the same. Now, there will be a difference between the two, and this difference is called as profit variance. Are you clear with this? What do you mean by variance? Variance means difference, right? The difference in profit. Now here, if you just report, yes, so and so is the amount of profit variance, that is not enough. We need to know why, what were the reasons that were resulting in this particular profit variance. That is the study of this entire chapter called as standard costing. Now, the profit variance is attributable to two broad reasons. One is the variances happening on the sales side. The other one is the variances happening on the cost side, right? So sales variances and cost variances. Now, if you further dig into it, cost variances can be further classified into 4 broad categories. It could be material cost related variance, labor cost related variance, variable overhead cost related variances, or fixed overhead cost related variance. Are you clear with this, guys? Yes. Now, in this particular CMA intermediate syllabus, right, if you are a student who is appearing for paper 8 cost accounting, in your syllabus, you have only material cost variance, labor cost variance. That's about it. Whereas if you are a paper 12 management accounting student, right, if you're writing the second group, in that case, all the variances are applicable. That is material cost variances, labor cost variances, variable overhead cost variances, fixed overhead cost variances, and even the sales side variances. We will see in sales side variances, there will be 2 different methods. One is called as a total approach. The other one is called as a margin approach. The entire subject, the entire chapter is applicable for paper 12 students. For paper 8 students, only these 2 variances, material and labor related variances are there. Are you clear with this, guys? Yes. Now, one more thing. In this chapter, we will be using 2 terminologies. One is called as a favorable variance. The other one is called as an adverse variance. What do you mean by a favorable variance? Any variance that results in increasing your profit is called as a favorable variance. Any variance that results in decreasing your profit is called as an adverse variance. Are you clear with this? For example, we are talking about material cost, right? Let us say you should have incurred 100 rupees, right? Standard material cost, whereas you have incurred 110 rupees actual material cost. In this case, there is a 10 rupee variance. But if I just mention 10, it is not sufficient for the purpose of decision making. I should say whether this 10 is a favorable or an adverse variance. You tell me you should have incurred 100, you have incurred 110, so you have incurred more cost. This results in reduction of your profit. This is an adverse variance. Are you clear with this? Whereas suppose you should have incurred 100 rupees, you have only incurred 90. This case also there is a 10 rupee variance, but that 10 is a favorable variance. Are you clear with this? Right? These are some basic things that you need to know. Clear with this, guys? Now let us get started with the material cost variances. Clear with this? Now, this entire chart, that's about it. You will be able to completely finish this material cost variances. Now, first I will do all the formulas, all the concepts that are involved in this chapter, and as I told you, we will do one full comprehensive sum where we will be applying all these formulas logically. Clear with this, guys? Right? Now, if you are attending, if you are learning standard costing for the first time, now this might not be fully sufficient. As the word suggests, this is a revision marathon, right? So the prerequisite for you to watch this particular marathon is that you should have already studied this entire concept of standard costing once. Now the whole purpose of this revision marathon is to help you recapitulate the entire chapter in a fraction of about 1 hour or 1 hour 15 minutes, or whatever it is that we are going to take to finish this particular chapter. Clear with this, guys? So now let us get started. Material cost variance. Now, by the way, guys, we all know all the cost side variances. So what is basically the variance? The standard cost minus actual cost. Basically what? The cost that you should have incurred versus the cost that you have actually incurred. Only that we can compare. Are you clear with this? Now, guys, in this case, material cost variance, what is the standard material cost? Which means what is the material cost you should have incurred? Standard quantity into standard price. What do you mean by standard quantity? To produce the actual production, how many kgs of raw material I should have consumed? Clear with this? Multiplied by, so per kg of raw material, what is the price I should have paid? This is the meaning. This has to be compared with what is the actual kgs of raw material I have consumed with what is the actual price that I have paid. Are you clear with this? Now, this is broadly classified into 2: price and usage variance. Now, material cost variance, if I just publish this figure, it is not enough. Now, immediately, what will the managing director ask? Now, who is responsible for this variance? Now, in this material cost variance, it could be the responsibility of 2 parties. One is the material price variance. The other one is called as the material usage variance. Now, come on, tell me, who is responsible for the price variance? Obviously, the purchase manager. Clear with this? And who is responsible for usage variance? Usage variance is the responsibility of production manager. Now, look at this. Purchase manager, what is he responsible for? He is responsible for purchasing the kgs of raw material. Now his responsibility lies in what? Negotiating the best deal for the company, correct? So what comes under his ambit? Standard price minus actual price. Let us say per kg he should have paid 10 rupees. But what has happened? This fellow has paid 11 rupees. Are you clear with this? For every kg of raw material, he has paid 1 rupee more. Are you clear with this? So now I'm clearly pinning out the responsibility on the purchase manager into actual quantity. Why am I multiplying this with actual quantity? Because this purchase manager has authority only to fix the price at which he can purchase. He has no control over the quantity that requires to be purchased. Why? Because it is the production manager who tells him how much quantity that he needs to purchase. Are you clear with this? Whatever quantity that the production manager tells, those many quantities he need to purchase at his particular discretion. That is what? His particular price. So his responsibility lies only with respect to the price. Multiply that with whatever actual quantity that he has been asked to purchase. So here the purchase manager is actually dependent on the production manager for the quantity decision. Are you clear with this? Now moving on to the other side, material usage variance. In this case, who is the person that we're talking about? Whose responsibility we're talking about? So production manager, what is he responsible for? He is responsible for consuming the raw material. So standard quantity, that is the kgs of raw material he should have consumed, minus actual quantity, the kgs of raw material that he has actually consumed. Clear with this, guys? Into what? Now this is in kgs. We need to convert this figure into a rupee value. So multiplied by standard price. So why here alone standard price? Because look, the production manager is not dependent on the purchase manager. Are you clear with this? Suppose I multiply this with actual price. What happens? The efficiency or inefficiency of the purchase manager gets passed on to the production manager. So I should not do that. Hence, I multiply this only with the standard price. Are you clear with this? This is the beautiful logic involved in standard costing. Many people are mugging this up. Please do not mug this up. Clear with this, guys, right? So now what is the formula here? Standard quantity minus actual quantity into standard price. So clearly remember here why we multiply the price variance with actual quantity, because the purchase manager is dependent on the production manager for the quantity decision. Whereas here in usage variance, we only multiply with standard price and not with the actual price. Why? Because the production manager is not dependent on the purchase manager for anything. Are you clear with this, guys? There is a one-way traffic. This is what I told in our regular lectures also. Clear with this, guys? Material usage variance. Now, usage variance alone is not sufficient. Suppose the company uses more than one type of raw material. Now, in this case, what happens? This usage variance is further classified into two: material mix variance and what? Material yield variance. Material mix variance is what? Revised standard quantity minus actual quantity into standard price. Clear with this, guys? So basically it is what it shows about, right? There are three types of raw materials: raw material A, B and C, right? Now overall maybe the quantity that I consumed would have been correct, but inside this I would have used more of a costlier raw material, lesser of a cheap raw material, or I would have used more of a cheap raw material, lesser of a costlier raw material. Now because of the deviation in the mix, how much is the amount that is attributable to the usage variance is what gets tracked down here in my material mix variance. Are you clear with this? And material yield variance is what? It is the balancing figure. Now look at this. We need to arrive at this figure: standard quantity minus actual quantity into standard price. Yes, on one side we have what? Revised standard quantity minus actual quantity into standard price. So this is going to be the balancing figure. It's going to be standard quantity minus RSQ into standard price. Or in other words, what you do, if you add up this two, that is, if you add up this two, what happens? RSQ and minus RSQ, it gets cancelled. Now what happens? Finally you get what? Standard quantity, you get this figure, minus actual quantity, you get this figure, the whole into standard price. So you get your, as I call it, daddy figure. That is the top figure, you will get it. Are you clear with this? Or in other words, you need not remember this. You can take this down as a balancing figure. Are you clear with this, guys? Right? So that's about this particular area. And of course, I told you this particular yield variance also has two other formulas. One is what? The actual yield minus standard yield into standard cost per unit, right? The other one is standard loss minus actual loss into standard cost per unit. Are you clear with this, guys? These are some really big derivations which we have actually done in our regular lectures, but here for this marathon, this is absolutely sufficient, or you can even take this as a balancing figure and you can close it off. Are you clear with this? That is the story of what? The entire concept of material cost variance. See how simple it is. It is worthwhile the investment of time that you make here. Clear with this? Please do not mug this up. The entire chapter is 100% conceptual and logical. Clear with this, guys? Now, once you understand the logics involved in material cost variance, now labor and variable overhead cost variances are exactly on the same line. Now, let's move on to the next one called as labor cost variance. Now, in labor cost variance, so what is going to be your formula? It's going to be standard hours into standard rate. Now, there in material, we use the word price. In labor, we don't call it as price, we use the word rate. Here, it's going to be what? Standard hours into standard rate minus actual hours into actual rate. This is nothing but what is the labor cost you should have incurred minus what is the labor cost which you have actually incurred. Now, this is broadly classified into three. This is broadly classified into three: labor rate variance on one side, labor efficiency variance on the other side, and labor idle time variance in between. Now, labor rate variance. Now, guys, tell me whose responsibility is labor rate variance? So, who is responsible for fixing the rate? The HR manager. The HR manager. Now, clearly visualize this. Now, what happens here? Now, labor rate variance, right? Standard rate minus actual rate. Every hour, he should have paid how much? 10 rupees. Whereas he has actually paid how much? 11 rupees, right? Multiply it what? Actual hours paid. That is what? For the entire actual hours spent by the workers in the factory, I need to pay them. Are you clear with this? Now, why do I multiply this with actual hours? Because this is not in the control of whom? This is not in the control of the HR manager. So, who decides on how many hours the workers need to spend in the factory? It is the production manager, because he makes them work. Are you clear with this? So similarly, there it was the purchase manager. Here it is whom? The HR manager. Are you clear with this, guys? The standard rate minus actual rate into actual hours paid. Now on the rightmost extreme side, what do you have here? So here we are gauging the efficiency or inefficiency of the workers. So what will you do? Standard hours minus actual hours worked by them. Actual hours worked by them in the factory, right, into standard rate. Are you clear with this? Why into standard rate? Because my production manager is not dependent on my HR manager. So if I take the actual rate into consideration, then the efficiency or the inefficiencies of the HR manager will get passed on to my production manager, which should not be the case. Clear with this, guys? Now, if you notice, here we use the word actual hours paid. Here we use the word actual hours worked. What do you mean by that? For example, in a week, my workers came to the factory, and in the factory, let us say they spent 100 hours, right? But what happened out of this 100 hours, 10 hours were actually lost due to some power cut, right? So 10 hours were lost due to power cut. So technically speaking, they worked only for how many hours? They worked only for 90 hours. Right? Now, when I'm judging the efficiency, I will only consider what? How many hours you should have taken versus how many hours you have actually worked, actually taken. Correct? I will only take 90 into picture. Whereas when I am paying them, I will pay them fully for the entire 100 hours. Why? Yes, obviously, this 10 hours, they came to the factory, but because of some inefficiency in the maintenance department, right, there was a power cut. Now, you cannot tell them that I will pay you only for 90 hours. You need to eventually pay them for 100 hours. So, for each of the 100 hours, the HR department paid them. Are you clear with this? So then what happens, sir? In between this 10 hours, it is not getting accounted. That's why we have something called as labor idle time variance. Idle time into standard rate, or in other words, idle time is what? It is the difference between your actual hours paid and the actual hours worked. Are you clear with this? Now that also gets tracked up, and this is always an adverse variance, right? It can only be adverse. It is a waste of money. I am paying them. It's a benefit lost. I told you, right? It's a benefit loss. I am paying the money, but I do not get any benefit out of it. Are you clear with this? These are the three variances under labor cost variances. Now, this labor efficiency variance can be further classified into what? Labor mix Mix is also known as gang. Labor gang or mix variance. Gang means what? Group of people is called as gang. So now when you have more than one skill set, like your what do you call your unskilled, semi-skilled and skilled workers and all. Now in this case, only when you have more than one skill set, you have this concept of mix or gang variance and all, and the other one is called as yield variance. So now similarly, gang variance, what is the formula? Revised standard hours minus actual hours worked into standard rate. That is the variance that is attributable to the deviation in the mix. So if I am using more of a cheap labor and less of a costly labor, if I'm deviating from the mix, what is the amount of variance that is attributable because I'm deviating from the mix is what gets captured here under the mix or gang variance. Are you clear with this? And on the other side, you have the labor yield variance, which is nothing but the balancing figure. If you see overall, if you add these two, this gets knocked off. RSH is there minus RSH. These two gets knocked off. You have standard hours minus actual hours worked into standard rate. You get the topmost figure. Clear with this? But there's also another formula, which is actual yield minus standard yield into standard cost per unit. Are you clear with this, guys? Right? Now, all these things, don't worry. We will be doing one full numerical problem, a comprehensive numerical problem. So do not worry. The application of these formulas, we'll be seeing it. You need not have to worry about it. Here, I'm just trying to explain all the formulas, the logic for every formulas. So originally all these logics and numerical problems, which took us 15 hours, more than 15 plus hours in a regular batch, I'm trying to consolidate it and present it in a capsule so that it is easier for you to revisit the entire core concepts of this chapter, in a fraction of about 1.5 hours. Clear with this, guys? Now let's move on to the next one, which is going to be variable overhead cost variances. Now variable overhead cost variances are fairly simple. Similarly, so what should be the variable overhead? Example, your power and fuel cost, right? So what should have been the variable cost incurred? Compare that with what is actually the variable overhead cost incurred. So what is it? Standard hours into standard rate minus actual hours worked into actual rate. Now always remember here for variable overheads, the actual hours are only actual hours worked. Why, sir? Their actual hours paid I will not consider. No, only when you turn on the machine, right? Only for every hour the machine is being running, only for that you'll be incurring variable overhead, right? Whereas that is not the case for labor. In labor, even if it is not working, for the labor workers I need to pay, right? Here we are talking about variable overheads. So actual hours always stands for actual hours worked. There is no concept of idle time and all when it comes to variable overhead. Clear with this, guys? We have even seen a few numerical problems regarding that. Now this is broadly classified into two: variable overhead expenditure variance, variable overhead efficiency variance. Now expenditure variance. Now tell me, guys, whose responsibility is your expenditure variance? Similarly, here the expenditure variance is the responsibility of whom? The maintenance manager. The maintenance manager. So now let us say, see, in our household, right? So what we do, so for every unit of power, we pay some 5 rupees, 6 rupees, 8 rupees, depending on which city or which state you are in. Are you clear with this? Whereas in case of companies, that is a completely different tariff altogether. They are using this for industrial use. In fact, some companies even use private power and all. There, they can negotiate. Now you and I cannot go and negotiate with the electricity board saying, you pay me 5 rupees, I will pay you 5 rupees per unit or 6 rupees per unit of power. No, we can't do that. Whereas companies for industrial use, they can do that. That negotiation is what we're talking about here. So standard price minus actual price. Here, let's say for every unit of power, or for every unit, right, for every hour for which the machine is working, for every hour for which you are using the power, right, they had planned, the company has mentioned that you can spend 10 rupees. Whereas what has happened, our maintenance manager, he had poor negotiation skill, because of which he finalized the deal at 12 rupees for every hour my machine is being running. Are you clear with this? So technically what has happened, they end up paying 2 rupees more for every hour they are using power facility. Are you clear with this? This is what gets captured here. Standard price minus actual price into what? Actual hours worked. Why we take actual hours here? Again, the same reason. The maintenance manager is dependent on the hours. So he's dependent on the production manager for the hour decision. Are you clear with this? He does not get any authority over deciding how many hours need to be spent here. Are you clear with this, guys? On the other hand, you have variable overhead efficiency variance. Efficiency variance is the responsibility of whom? Again, the same guy, the production manager. So here what comes in, guys? Here it's going to be standard hours, the hours that you should have spent, minus actual hours worked. the whole into standard price. Are you clear with this? Why do I use standard price? If I use actual price, then the efficiency or inefficiency of my maintenance manager gets passed on to the production manager in a scenario where the production manager is not at all dependent on the maintenance manager. Are you clear with this, guys? There is a one-way traffic. Now, maintenance manager is dependent on the production manager. That's why I use the actual hours here. Whereas the production manager is not dependent on the maintenance manager. That's why I don't use the actual price here. I only use the standard price. Are you clear with this? Have this crystal clear clarity. Now, where will you go wrong? You tell me. Clear with this, guys? Now, that is all the entire story about variable overhead cost variance. Now, here efficiency variance further classified into mixed yield. That concept itself is not there. Clear with this, guys? Only it stops here. Now, let's go on to the next one, which is fixed overhead cost variances, right? Now, fixed overhead cost variances, it is completely a different animal altogether. Here, we compare what with what? We compare absorbed fixed overheads with actual fixed overheads. Clear with this, guys? So, basically, fixed overhead cost variance represents what? Under absorption or over absorption. Clear with this, guys? Many students think that it is standard fixed cost versus actual fixed cost. First of all, when it comes to fixed cost, there is no concept of standard. You only have budgeted fixed overheads, you have actual fixed overheads, you have absorbed fixed overheads. There is no question of standard fixed overheads and all, because the concept of standard comes only for the components of variable cost and all. Clear with this, guys? For the actual production, what should have been the material cost you should have incurred? What should have been the labor cost you should have incurred? What should have been the variable overhead cost you should have incurred? Whereas fixed costs, irrespective of your volume, it remains the same only, no? Are you clear with this? There is no concept of standard here when it comes to what? Your fixed overheads. Now, so fixed overhead cost variance is basically capturing what? Your under or over absorption. Was the formula? Absorbed fixed overheads minus actual fixed overheads. Now, this gets branched into two: expenditure variance and volume variance. Expenditure variance is what? So now, let me just give you an example, right? So you have what? Budgeted fixed overheads, right? So let me just take this up. Budgeted fixed overheads, right? Budgeted fixed overheads. Let's say I budgeted a fixed overhead of 100 rupees, right? But I absorbed a fixed overhead of, let us say 90 rupees. Whereas the actual fixed overheads was how much? Let us say it was 110 rupees. Are you clear with this? Now, this particular concept of fixed overhead cost variance compares what with what? It compares absorbed fixed overheads with actual fixed overheads. In this case, it's going to be what? So absorbed fixed overheads 90, actual fixed overheads is how much? 110. So basically here it's going to be 20 adverse. Are you clear with this? Now, expenditure variance talks about what? It compares what and what? My budgeted figure with what? With my actual figure. It is 100 minus 110. You have incurred 10 rupees more. Are you clear with this? Budgeted minus actual. Now, what is fixed overheads volume variance? It is actually the balancing figure. This is how I asked you to remember. Are you clear with this? Balancing figure. That is what? So, the daddy, that is the top figure, compares absorbed with actual. Right? On the left side, I am comparing budget with actual. So on the right side, the balancing figure should be what? So I should now remove this figure. That is absorbed fixed overheads minus budgeted fixed overheads. Or in other words, if you add these two and see, you should get the top figure. Now in this case, budgeted fixed overheads minus budgeted fixed overheads, it gets cancelled. Basically what you will get as a topmost figure, absorbed fixed overheads minus actual fixed overheads. You will be getting this figure. Are you clear with this, guys? Are you clear with this? So this is just for the purpose of understanding that I mentioned you. Clear with this, guys? Are you all able to understand? Yes. So now, fixed overheads expenditure variance is what? Budgeted fixed overheads minus actual fixed overheads. Your volume variance is going to be what? Your volume variance is going to be absorbed fixed overheads minus budgeted fixed overheads. Now, your volume variance is further classified into two. What and what? Capacity variance and efficiency variance. Capacity variance is what? Actual hours into standard rate. So for the actual hours, if you multiply the standard rate, what is the figure that you will get? Compare that with budgeted fixed overheads, right? Once again, efficiency variance is the balancing figure. That is what? If you add this two, you should get the daddy, the top figure. So now if you see here, this actual, so here the formula is absorbed fixed overheads minus AH into SR. So AH into SR and AH into SR gets cancelled. If you add up these two, you will get absorbed fixed overheads minus budgeted fixed overheads. Are you clear with this? So this should be coined in such a way that if you add this figure with capacity variance, you should get the volume variance. So what will you do that? How will you do it? Very simple. So very simple. So here what will you do? You have AH into SR, which you don't have in the topmost figure. So subtract that. That needs to be removed. And now I need to have absorbed fixed overheads that you introduce here. So absorbed fixed overheads minus AH into SR, you get this efficiency variance. Are you clear with this, guys? Now it doesn't stop here. The capacity variance is further classified into two: the revised capacity variance and calendar variance. Very simple. It is just one small tinkering they do. This is nothing but the same thing only here. It's going to be AH into SR minus revised budgeted fixed overheads. Are you clear with this? This generally we have seen this. When do we use this? When the number of days in the budget data and the number of days in the actual data are different. So what we do is we use this concept of calendar variance and all. So immediately what happens? I should get the daddy figure. What will I do? I will remove this revised budgeted fixed overheads minus budgeted fixed overheads. So basically what happens? This gets revised here itself. It gets reversed here itself. If you add up the two, you will get the topmost figure. Are you clear with this? So here it's AH into SR minus budgeted fixed overheads. So your revised capacity variance, what is it going to be? AH into SR minus revised budgeted fixed overheads. Immediately I will say revised budgeted fixed overheads minus budgeted fixed overheads. These two figures get cancelled here. Ultimately, if you add up the two, you will get the top figure. Are you clear with this? This is entirely a subject matter of what? Arriving at the balancing figures. But this top area, you need to know what fixed overhead cost variance stands for. It stands for under or over absorption. So once again, let me just tell you, this is the most difficult area in this entire chapter because it deviates from whatever the other variances talk about. Here the fixed overhead cost variance is what? Your absorbed minus actual. On the left side you have expenditure variance. It's going to be budget minus actual. So your volume variance is going to be your balancing figure. That's absorbed minus budget. Now volume variance segregate into two: capacity and efficiency. Capacity variance AH into SR minus budgeted fixed overheads. Now here what do? I need to arrive at the topmost figure. So once again use the concept of balancing figure. Absorbed fixed overheads minus AH into SR. You get this. Now your fixed overhead capacity variance gets classified into two: revised capacity and your calendar variance. Revised capacity is going to be AH into SR minus revised budgeted fixed overheads. Immediately that needs to be reversed. Revised budgeted fixed overheads minus budgeted fixed overheads. Are you clear with this? This is the entire summary of your fixed overhead cost variances. So right, this generally we take a lot of time in doing this fixed overhead cost variance, about 4-5 hours we take. But here, since this being a revision marathon, I have just subsumed it and I'm presenting it in a capsule so that it's easy for you to revise it. Clear with us, guys? Right, now let's move on to the next one. That's about the 4 cost side variances. Now let's move on to the next one, which is called as the sales side variances. The sales variances. Number 1, sales variance can be done under 2 approaches. One is called as a total approach. The other one is called as a margin approach, right? So what is this total approach stands for? Very simple. So this total approach basically captures what? Your budgeted sales minus actual sales. Are you clear with this? Budgeted sales minus actual sales. What is the sales that you should have made? Basically the sales that you budgeted minus whatever sales that you have actually made. Now again remember, there is no concept of standard sales when it comes to sales. Are you clear? When it comes to sales, there is no concept of standard. Why? See, I am planning to sell so many units. I have actually sold so many units. There can only be budget and actual. Right? You can't have something called as standard and all, unlike the variable cost side variances like your material, labor and variable overhead. Are you clear with this? So yes. Now, what is the total side variance? Very simple. Budgeted quantity into budgeted price. That gives you what? The budgeted sales minus what? Actual quantity into actual price. As simple as that. Are you clear with this? This gets classified into 2. Now, if I just present the sales side variance, total sales variance is so much. That is not enough. Now, immediately your managing director will ask, why has the sales variance happened? Bifurcated into 2. What and what? Sale price variance and sales volume variance. Sale price variance. Who is responsible for sales price variance? Your marketing team, your marketing manager. Are you clear with this? This guy fix your selling price and all that, right? Now every unit I should have sold it for 10 rupees. Now guys, this guy was able to sell at 11 rupees. Now, what has happened in this case? It's a favorable variance. Why? Sir, 10 rupees or 11, this is not cost side variance. Had it been cost, it would have been adverse. Here it's a sales side variance. So every unit I plan to sell it at 10 rupees. But what have I done? I've done a good job. My marketing manager has done a good job. He's able to sell it at 11 rupees. It's a benefit for me. The variance that goes on to increase your profit should be a favorable variance. In this case, it's a favorable variance, right? So budgeted price minus actual price into what? Into actual quantity. Why? Because the quantity decision is not taken by the marketing manager. Then who takes the quantity? The volume decision, who takes it? It is taken by another guy called the sales manager. Are you clear with this? He decides on how many units to sell. This marketing manager decides on what should be the selling price. Clear with this, guys? So the marketing manager is dependent on whom? The sales manager. So the same logic here. So into actual quantity. When I say quantity, it means what? Units sold here. Are you clear with this? Now on the other side, the sales volume variance, what is it? Who is responsible for the volume? Sales manager. So budgeted quantity, you should have sold 10,000 units, right? But you have sold how much? Only 9,000 units. Are you clear with this? Right? Budgeted quantity minus actual quantity. But I can't leave it in units. I need to convert it into rupee. So multiply it with what? Budgeted price. Now, why should I not multiply with actual price? Because the sales manager is not dependent on the marketing manager for anything. Are you clear with this? If I take the actual price here, then the efficiency or the inefficiency of the marketing manager will get wrongly passed on to the sales manager. Are you clear with this, guys? Are you clear with this? Hence, it still stands with budgeted price. Every single thing is the same logic. Not even a single formula needs to be marked up here. Clear with this, guys? Right now, the volume variance can be further classified into what? Sales mix and sales quantity variance. Now, when will you have these two bifurcations? When the company is dealing in more than one type of product. Are you clear with this? So here, what is the formula? Revised standard quantity minus actual quantity into what? The budgeted price, and this is going to be the balancing figure. The budgeted quantity minus revised standard quantity into what? Into budgeted price. Now, guys, basically, what is this? Now the company deals in more than one type of product. Now if I'm selling more of a costlier product, less of a cheaper product, now because of the deviation in the mix, what is the amount that is attributable to my overall sales volume variance is what gets captured here. Now here the quantity variance, what does it track? Overall, A plus B plus C put together, you should have sold 10,000 units, but you have sold 11,000 units. Because of deviation in the overall quantity, how much is the amount that is attributable to my volume variance gets captured under quantity variance. Are you clear with this, guys? This is what this entire total sales variance under total approach talks about. Basically, remember, the sales variance under total approach captures what? The difference in the budgeted sales revenue, right? Budgeted revenue versus the actual revenue. Whereas, what does this margin approach talk about? What does this margin approach talk about? This margin approach is exactly the same. Wherever you use budgeted price, you use budgeted profit or budgeted margin. Wherever you use actual price, you will use actual margin. Are you clear with this? Here it says what sales margin variance is budgeted quantity into budgeted margin minus actual quantity into actual margin. For example, I was planning to sell 10,000 units, and every time I sell a unit, I know that I will be getting how much? I plan to earn a margin. What do you mean by budgeted margin? Look at this. Budgeted margin is nothing but the budgeted selling price minus the standard cost per unit, or in other words, the budgeted cost per unit. Are you clear with this, guys? Right? So if I sell every unit, what is the profit that I am planning to earn for every unit? Are you clear with this? Right? So I was planning to earn a total profit of how much? 50,000 rupees. Are you clear with this? Whereas, what is this actual quantity? I ended up selling 12,000 units. Very good. But every time I sold a unit, the actual margin that I got was how much? It was only 4 rupees. Are you clear with this? So 12 into 4 is how much? 48,000. So here we are trying to find out how much amount of profit is, what is going to be the profit variance attributable to the sales side. Are you clear? This is not the overall profit variance. We are here capturing what is going to be the difference in profit arising purely on account of the sales side. Here, the cost side variances are not even considered. Are you clear with this? That is what has been done here. So sales variances alone can be done under total and margin approach. Clear with this? And one very important thing here is the calculation of actual margin. How do you calculate actual margin? First, how do you calculate budgeted margin? Budgeted margin is also budgeted selling price minus standard cost per unit. Basically, budgeted cost per unit. Clear with this? Anything you can call it. Actual margin, what you will think? Sir, actual selling price minus actual cost per unit. No, it is actual selling price minus standard cost per unit only. Are you clear with this? It is actual selling price minus standard cost per unit only. Clear with this, guys? The reason for this, we have seen this in depth in our regular batch. But anyways, can we just give you a small glimpse of it? Here I only take the standard cost per unit because the actual cost side variances are anyways getting captured under my cost side variances. Material plus labor plus variable overhead plus fixed overhead. Clear with this? So here I am just trying to capture the change in variance attributable to the sales side because of the change in my sales side. Are you clear with this? That is the reason why here the actual margin calculation is actual selling price minus standard cost per unit. And one more thing, guys, which I again told you in the regular batch, this clarity is lacking in our CMA Institute study material. So that's why I asked you to make a specific note of this also, because every sum they have used some, they have used different ways, but ultimately what they have done is only this. The back end calculation is only this, but every sum they have given different ways of doing it. But ultimately the answer will match with whatever we have learned only. So please follow this. It will make your life very simple. And one more thing, the word budgeted margin and budgeted profit, the word margin and profit can be interchangeably used. Budgeted margin or budgeted profit are the same. Actual margin, actual profit, these are all same only. So the word margin and profit can be interchangeably used. So now what is your sales margin variance? It's going to be budgeted quantity to budgeted margin minus actual quantity to actual margin. Classified into two, segregated into two. Sales margin price variance. What is it? Simple. Instead of price, you put margin. Budgeted margin minus actual margin into actual quantity. On this side, it's going to be sales margin volume variance, budgeted quantity minus actual quantity into budgeted margin. Now further classified into mix and quantity variance, revised standard quantity minus actual quantity to budgeted margin. Here it's going to be budgeted quantity minus revised standard quantity into budgeted margin. Clear with this, guys? Basically what happens here, it is the total approach only. Instead of price, you use margin. If it is budgeted price, here you use budgeted margin. If it is actual price, here you use actual margin. And that's about this entire formulas and concepts involved in this chapter in a nutshell. Are you clear with this, guys? Right? So with this, we have covered all the concepts, all the major concepts involved in this chapter. Now, one more thing. I think there are one or two questions involved that are involving reconciliation, right? That I am not doing it in our marathon. In our regular lectures, that is also done, but do not worry about it. The main core area of this particular chapter revolves around this calculation of all the variances. So basically, what are the different types of variances that we have got? We have got 4 cost side variances and 1 sales side variances: material cost variance, labor cost variance, variable overhead cost variance, fixed overhead cost variance. And on the sales side, the variances are calculated under 2 approaches. One is under total approach, the other one is under margin approach. Clear with this, guys? Right? Now what we will do is we will take up one question. We will take up one full question, right? And the comprehensive question, single question, right, that touches upon all calculation of all the cost as well as the sales variances both under total and margin approach. A comprehensive question. It is there in our institute study material only, which we did in our regular batch. If you remember, in our regular batch, I also asked you to mark it as important, a must visit sum the day before exam and all. I gave you guys a library of adjustment. So that sum only we are going to do right now. Fine. So now let's get started. Now let's move on to the comprehensive numerical problem, right? So this is question number 34 that we did in our regular batch. So basically this is our regular course material that I'm using right now. So now let me just read out the question for you. The following information related to a manufacturing concern is given below, right? They have given the word standard weight. So what I've told you before, just because they have given the word standard, please do not get misled, right? What do you mean by standard? For the actual output, what should have been the cost which you should have incurred, correct? Now, sometimes the word standard which is used in the question ideally refers to budget, right? So we should see for what volume level they are given this data. Based on that only you can conclude whether this is actually standard or budget, right? Now, first they have given material A 24,000 kgs, the rate of 3 per kg, 72,000 rupees. Material B 12,000 kgs, the rate of 4, it's 48,000. Wages is 60,000 hours at the rate of 4 per hour, it's going to be 2,40,000. Variable overheads is going to be 60,000 hours. It's going to be how much? The rate of rupee 1 per hour, it's going to be 60,000 rupee. Fine. Then you have fixed overhead 60,000 hours, the rate of 2, it's going to be 1,20,000. The total cost is 5,40,000. Budget profit is 60,000 rupees. So the budget sales is going to be how much? 6 lakh rupees. And the budgeted units of production is going to be how much? 12,000 units. So basically they have given us the entire budget for pertaining to how many units? 12,000 units. Now look at this. Actual first units sold is 9,000. Wait, immediately what you can conclude? Basically this data, the word they have used, but standard here is actually not standard, it is budget. Why? Had it been a standard data, this would have been for the actual production. For you to produce, or for you to actually produce and sell so many 9,000 units, what should have been the cost you should have incurred? That's how it should have been, right? Fine. It is not like that. It is pertaining to a different volume level. So clearly it's a budgeted data. They have given the word standard as a trap. Clear with this. Don't fall for it. Next. So sales given 9,000 units. The sale value, actual sales is going given as follows. Material consumed A and B in terms of kgs is given, in value is given. If you divide the two, you will get the kg, the actual price per kg of A and B. Wages paid. They have paid wages for 48,000 hours. The value is given. If you divide the two, you will get the actual rate. The fixed overheads actually incurred is given. Variable overhead actually incurred is given. Labor hours worked. Now be very careful. Labor hours worked is 47,700. Right? The labor hours paid is how much? 48,000. The difference of 300 is nothing but your idle time. Are you clear with this? Abnormal idle time. Basically, this is what gets captured under the idle time variance, which we have seen. Right? Now, very, very important and a beautiful and a unique adjustment in this particular question is with respect to your closing WIP. Now, they have given that closing WIP is how much? 900 units. Obviously, WIP is what? Incompleted units. They have given the degree of completion. With respect to material A and B, it's 100% complete. With respect to wages and overheads, it's 50% complete. Simple. You're required to calculate all the variances in this particular concern. Now guys, a beautiful question. In fact, if you remember, I asked you to mark this as important. I gave you the library of adjustment, that is basically in our regular batch. I dictate for every single sum that we do, I dictate what the sum was about, right? So there I gave you, this is a comprehensive sum where we had to calculate all the variances, right? Your material variance, labor variance, variable overhead, fixed overhead, a sales variance under total and margin approach. And this sum over and above all these things had a unique stock adjustment, that too closing stock, that too with different degree of completion. One of the most top rated question in this entire chapter. This is what I told you in our regular batch also. That is the reason why I picked this up for the purpose of revision. Now, before we get into this particular problem, I want to tell you one very important thing. The solution given, this is a study material question, a very good question. We should appreciate that the institute has taken this question in the study material. But on the flip side, I want to tell you guys that the solution given in the institute study material is wrong. They have made a lot of mistakes and error with respect to this question. So this entire question, I have solved it, which we will be doing right now, right? The solution will also be provided to you. Do not miss this sum. This one single question is a brilliant and a strategic way to revise the entire chapter. Having covered all the concepts, this is a must visit sum. In fact, mark this sum as important the day before your exam, or even if you're just 1 or 2 hours before your start of your exam. Even in that case, I would suggest that if you want to revise standard costing, pick this sum. That is the importance of this sum, because it tells a lot of other things as well apart from whatever we've seen till now. Now guys, let me tell you one very, very important thing in this particular area. Now basically, if you see, we have this, all the variances we've got, right? The variances are classified into what? The cost side variances and sales side variances. Cost side variances further bifurcated into material variance, labor, variable overhead, fixed overhead variances, and the sales side we have total and margin variance. Now always remember this, sales variances, right, are always tied to units sold. Obviously, the sales is pertaining to units sold, whereas cost side variances are tied to units produced. Why? Because whatever cost I incur these costs for the production, not for units sold. Sir, what are you saying, sir? Can you give us an example? Yes. Let us say I have produced 10,000 units, right? Now forget this question. I'm just giving you an example. I've produced 10,000 units. Out of these 10,000 units, I have sold 8,000 units, right? And I have unsold, that is, I have produced and I've kept as a stock with respect to 2,000 units. Now you tell me, all the costs that I incur, are they incurred only with respect to the units sold, or are they incurred even with respect to the 2,000 units which I have produced, but I have deliberately kept it as a stock? Yes. So I incur these costs with respect to both the units sold and the units unsold. Or in other words, all the costs are incurred for the production. Whereas with respect to sales, they are exclusively pertaining to sales only. So they are tied to units sold. So always remember, for all our calculation purposes, what we need to do is the cost side variances are tied to the units produced and the sales side variances are tied to units sold. Number one. Number two, in this question, basically, you don't have any opening stock and all. So what is the total number of units produced? Now be very careful here. So basically, what is the total number of units produced? Sir, I was able to sell 9,000 units. So I produced 9,000 units plus some units I have kept in stock, 900 units. Now wait, I cannot add this 9,000 units with this 900 units and say, okay, sir, totally I have produced 9,900 units. No, had it been FG, then I could have added this, but this is a WIP. They have a different degree of completion. These are incomplete units. What they are saying, with respect to raw material, these products, these 900 units are fully completed. However, with respect to labor and overheads, they are only semi-finished. They are only 50% complete. So what we need to do is, using raw material costs, how many equivalent units I have produced, I need to calculate that. Using wage cost, how many equivalent units I have produced. Using wage and overheads, how many equivalent units I have produced, I need to calculate that. So basically, the actual units produced for the purpose of computing my material cost variance will be different, and the actual units produced for the purpose of computing my wages and overheads will be different. Are you clear with this? What is this? Let me just walk you through this. Now look at this. See, in our institute study material, right, up to this they have done correctly, but while for the purpose of calculating variances, left, right and center, there are a lot of mistakes. So that's why I've written the entire question for you. Now look at this, guys. In order to calculate the cost variances, these are the exact words given in the study material which I've kept in our handbook. Right? In order to calculate the cost variances, the statement of equivalent production is prepared first, and to prepare the statement showing standard and actual cost of material, which are shown as below. So basically, statement of equivalent production, what they have done, simple, guys, do not worry about it. Now I have consumed raw material A and B. Using raw material A and B, totally how many units got produced? Units completed, 9,000 units definitely got completed. Now I also produced the closing WIP. How many units of closing WIP were there? 900 units, and each of these 900 units have consumed the entire raw material A and B, correct? Or in other words, with respect to material, they were 100% complete. So here 900 into 100%, how much is that going to be? It's going to be 900. So with respect to raw material, I have actually consumed my raw material cost, and I have produced how many equivalent units? 9,900 equivalent units. Are you clear with this? This is the interpretation. Whereas with respect to labor and overheads, by consuming my labor and overhead cost, how many units have been produced? Anyways, this 9,000 units sold, they are fully complete. Only if they are complete, they can be sold, right? So 9,000 units. However, if you look at the question, they have clearly mentioned here that, look, with these 900 units lying in your closing WIP, they are only 50% complete with respect to what? 50% complete with respect to labor and overheads. Or in other words, 900 units, 50% complete is equivalent to 450 units, that is half of it, 450 units fully complete. Correct, guys? Yes. So what we do here is 50% of 900, will say 450. So 9000 plus 450, 9450. So for the purpose of computing my labor and overhead variances, I will say by consuming my labor cost and overhead cost, 9450 equivalent units got produced. Are you clear with this? This is one very unique question where you had different equivalent units for different components of cost. Ideally speaking, this is actually a concept which we see in paper 8 cost accounting. There in the chapter called as process costing, we see that they have beautifully merged it and they have put it here under standard costing. Clear with this, guys, right? This is the reason why I rated this sum as the topmost sum in this entire chapter. Clear with this, and I wanted to discuss this in our marathon right now. Fine, guys. So now what we do right now, we need to calculate all the variances, right? So now let us get started. Now first, part 1 is about calculating material cost variance. Now immediately what you need to do, by consuming my material cost, how many equivalent units got produced? 9900. Sir, how do you know? Just now we calculated and just now we saw, right? So just now we saw what was the equivalent, one second. Yes, just now we saw. So how many equivalent units got produced by consuming the material cost? 9900. Clear with this, guys? So 9900 equivalent units got produced. So now what we need to do, we need to calculate the standard quantity of raw material A and B. Now, if you look at the question, what have they given in this question? They have mentioned that, look at this, 24,000 kgs of material A and 12,000 kgs of material B, right? This is there in the budgeted data, right? Should have been consumed to get an effective output of how much? 12,000 units. Are you clear with this, right? So now this is what I have mentioned here separately. Now the budgeted data, it's actually not standard. The budget data is, so you can consume 24,000 kgs of A and 12,000 kgs of B, right? If you consume these two, you will effectively get an output of how much? 12,000 kgs of output of your product, units of output, not 12,000 kgs, 12,000 units of output. Now, what do you mean by standard quantity? To achieve my actual production, how many kgs of raw material A and B should have been used? So what is your actual output? 9900. So for me to achieve 9900 units of output, how many kgs of A and B I should have consumed? Very simple. If 24,000 kgs I can consume to get an effective output of 12,000 units, how many kgs of A I should consume to get an effective output of 9900? So here it's 24,000 divided by 12,000 into 9900. Clear with this? So 24,000. If 24,000 is for 12,000, how much is it for 9,900? Proportionately, you will get what? 19,800. You should have consumed 19,800 units of A. Similarly, kgs of B, how much is it? 12,000, right? Divided by 12,000 units into 9,900. You get what? 9,900 kgs of B. Are you clear with this? With this, we get the standard quantities of raw material A and B, which is 19,800 kgs of A, 9,900 kgs of B. Clear with this, guys, right? Now what do we do? Yes, now we can prepare the statement. Standard quantity A and B, we just now got the figures, right? You add up the two. Totally how many kgs? Totally how many kgs of A plus B were inputted? 29,700 kgs of A plus B were inputted, right? So this got converted effectively into 9,900 units of output. Are you clear with this? This is the meaning, right? Now, what is the standard price? It's given in the question 3 and 4. These figures were given in the question, right? Let us multiply the two because we anyways will be needing this figure. Standard quantity into standard price. If you multiply this, you get 59,400 and 39,600. If you add up the two, totally 99,000 rupees is the total raw material cost you should have incurred for an actual output of 9,900 units. This is the meaning. Are you clear with this, guys? But what has happened? Actual quantity and actual price, these data, we can arrive at it from here. So now how much actual kgs of A and B were consumed? 22,275 and 10,890. Clear with this, guys? So 22,275, 10,890. These were the actual quantities of A and B consumed, right? And what was the actual cost of A and B? These figures are also there. 62,370 and 44,649. You can just put these figures here. 62,370 and 44,649. Now divide the total value with the actual quantity. you will get the actual price also. Are you clear with this? Now we have got all the ingredients basically for calculation of the variance. What do you need? You need the standard quantity, standard price, actual quantity, actual price. Now raw material wise, we have all the breakup. Right now it's just a matter of substituting the figures and arriving at the answer. Now first guys, what is the total material cost variance? So standard quantity into standard price minus actual quantity into actual price. Basically, we have already done this. So you were allowed to incur a total cost of how much? 99,000, but you have actually incurred a total cost of how much? 1,07,019 rupees. So what you do here, 99,000 minus 1,07,090, basically you get how much? 8019 as adverse variance. This is your overall material cost variance. You have incurred an extra material cost to the tune of 8,090. Are you clear with this, guys? Now if I leave it here, is it enough? No, I need to further deep dive and find out the reasons for this. Basically your price and your usage variance. Now price variance, basically this has got repeated here, do not worry. Material price variance, what is the formula? Standard price minus actual price into actual quantity. Logic, because we are talking about the purchase manager. The purchase manager is responsible for the price that comes within the bracket. Standard price minus actual price. He is not responsible for the quantity. He is dependent on the production manager for the quantity addition into actual quantity. Now what you need to do, raw material wise, pick the figure. So where are the figures? We just got it here. So for example, for raw material A, so how much is this? So I'm just erasing all these things, the ticks that I've put. Just a minute. Right? So now for raw material A, standard price was 3, but you have actually incurred only 2.8. Clearly there is a saving here into actual quantity, 22,275. Look at this, just a matter of substituting, guys. 3 minus 2.8 into 22,275. So clearly you see every unit he has saved the company 0.2 rupees, right? So clearly it's a favorable variance. So if you multiply that, you get 4455. Similarly for product B, it's going to be 4. You should have spent 4 rupees, but you spent 4.10. You've paid more. It's an adverse variance into actual quantity, which is 10,890. Look at this. You get a 1,089 as adverse. So you knock these two off. You get a net effective favorable variance of how much? 3,366 favorable. Clear with this, guys? Just a matter of substituting the figures. See how easy it is. The entire crux lies in putting this table. Once you put that, it's just a matter of substituting the figures. Now let's go on to the next one, the usage variance. Formula for usage variance, standard quantity minus actual quantity into standard price. Who is the responsible guy? You guys know it. Who is he? The production manager. So now standard quantity, you can pick this up from this table. So 19,800, 9,900. So 19,800, 9,900. Actual quantity, you can pick it up from here. 22,275 and 10,890. So 22,275, 10,890 into standard price is going to be 3 and 4 respectively. You can just get these figures. So now guys, for raw material A, he should have consumed 19,800. He's consumed 22,275. Clearly, it's an adverse variance. You multiply, you get the figure and put it as an adverse variance. Similarly, for raw material B, he could have consumed 9,900. Again, you've consumed what? 10,890. More you've consumed into 4. So here also it's an adverse variance. Add the 2, you get what? 11,385 adverse. Clear with this, guys? Now what you need to do not proceed further immediately. Wait. So material price plus usage variance should be equal to your daddy. That's your cost variance, right? Let us see here. Here you get 3366 as favorable and 11,385 as adverse. So 3366 minus 11,385. How much is this? 8019 adverse. It is tallying. So immediately you can find out that whatever you have done is correct. Are you clear with this? Now further, usage variance gets classified into mix and yield variance. Mix variance, what is the formula? I told you guys, revised standard quantity minus actual quantity into standard price. But I told you, technically speaking, the word should not be RSQ, revised standard quantity. It should have been revised actual quantity. But in our institute study material, they have used the word revised standard quantity. Let us stick to it. Clear with this, guys, right? So now how would you do this? This is what I said I will explain when we are doing the numerical problem. Now, how will you arrive at this? This RAQ is nothing but revised standard quantity, guys. Clear with this guy, right? Now, what you need to do, actual quantity. How much is the actual quantity? So we have the figures here. The actual quantity is 22,275 and 10,890. Put this. First, you need to fill this column, right? You add up, you get how much? 33,165. Now, just insert this 33,165 here. Clear with this, guys. Now, revised standard quantity means what? The actual quantity in the standard mix, meaning what? Totally, what is the total kgs of raw material I've used? 33,165. Fine. But this you should have consumed in your original mix. What is the original mix here? So the mix should have been 24:12, correct? Because that is there in the budget. Clear with this? 24:12, or in other words, 2:1 should have been the mix using which you should have consumed. Every time you are consuming 3 kgs, 2 kg should come from A and 1 kg should come from B. Are you clear with this? That's how it should have been, right? The standard mix. Clear with this? So now if I do it that way, how much is it? So 33,165 into 2 by 3, that will give you 22,110. 33,165 into 1 by 3, how much is this? That is going to be 11,055. Are you clear with this? Basically, this RSQ is nothing but the actual quantity at the standard mix. Are you clear with this? So now what you do? Now you could have consumed 22,110. You have actually consumed more, 22,275. So clearly it's an adverse variance. You calculate this 22,110 minus 22,275 into 3. You get 495 adverse. Similarly, you could have consumed, what has happened, 11,055, but you've just consumed how much? 10,890. So now clearly this is a favorable variance. So into 4 you get how much? 660. So now overall you get a favorable variance. Now what is the meaning of this? Clearly you see, now guys, what has happened between A and B, which is a costlier material? Obviously B is a costlier material, correct? Now what I have done, I have actually used what we have done, more of a cheaper material and less of a costlier material. Since I've used more of a cheaper material, less of a costlier material, it ended up in a price saving, which resulted in a favorable variance. This is what gets captured under mixed variance. I told you, no, more of a cheap and less of a costlier material. Because of this, what is the amount attributable? That is what is getting tracked here under my material mix variance. Are you clear with this, guys? Are you clear with this? Next, material yield variance. You can do it as a balancing figure, or I told you one of the formulas is what? Actual yield minus standard yield into standard cost per unit. Now guys, what is the actual yield? Yield is basically output. Actually, using my material cost, 9,900 units has been produced, right? But how many units should have been produced for the kgs of raw material that has been inputted weight? How would we calculate that? Now all this calculation is not given in the study material. They have just mentioned the figures here. Now let me clearly tell you how this works. Now basically guys, what has happened here is, look, how do you calculate the standard output? If I input a total of 29,700 kgs of raw material, I should get an output of 9,900, correct? But I have actually inputted how many kgs of raw material? 33,165, A plus B put together. For the actual kgs of raw material, what should have been the yield or output you should have got? This is the calculation that is called as standard yield. How would you do that? How would you do that? Very simple. So 9,900 divided by 29,700 into 33,165. That is what we have done here. 9,900 divided by 29,700 into 33,165. For the actual input, you should have got an output of how much? 11,055. But you have actually got only 9,900, and every unit of output costs me how much? Every unit of output cost me out. Standard cost per unit. Very simple. You go there and find out here. So every unit of output, how much does it cost? The total cost is how much? 99,000 rupees is the total cost for an output of how much? 9,900. Standard cost per unit. You are allowed to incur 99,000 rupees for an output of 9,900. For every unit, how much you are supposed to incur? 10 rupees. Are you clear with this? 10 rupees you are allowed to incur. So basically what has happened here is my material yield variance is, so you should have got, the actual yield was only 9,900, but I should have got, for whatever I inputted, I should have got 11,055 units, right? So I have got so many units less, my actual yield is less, and every unit cost me 10 rupees. So overall, what is going to be my yield variance? 11,550 adverse. Are you clear with this? Why adverse? Because the actual output that I got was less than the standard output that I should have got, which means what? Clearly there is an adverse variance, and in this case it is to the tune of 11,550. Clear with this, guys? Or I don't want all these things, sir. You can also use the the other formula that we have done, the balancing figure formula, standard quantity minus revised actual quantity into standard price. If you do that way also, you will arrive at the same figure only. Clear with this, guys? Now let's move on to the next one, which is going to be my labor cost variance. Now guys, now immediately for the purpose of labor cost, what is the actual units, what is the actual output that got produced? 9450. Clear with this, guys? 9450. The first thing that you need to mention is 9450, that is got mentioned. Now labor cost variance, what are the different components that you need? Standard hours you need, standard rate, right? Fine, it's got repeated here, standard rate. Then actual hours paid, actual hours worked, idle time, and you need the actual rate also. If you list out these ingredients, automatically you can find out the labor variances. Now guys, so what is going to be the standard hours? What do you mean by standard hours? For me to get the actual output, how many hours I should have spent? Now look at the question. Look at the question. What have they given? The budgeted data. Go to the budgeted data. You are allowed to take 60,000 hours to get an effective output of how much? 12,000 units. So I can take 60,000 hours, right, to get an output of how much? 12,000 units. But for me to actually get an output of how much? For me to actually get an output of 9450, how many hours I should have taken? For me to get an actual output of 9450, how many hours I should have taken? This is called as standard hours. Clear with this, guys? This is the calculation. 60,000 hours upon 12,000 units into 9450. So for you to achieve an actual output of 9450 units, you should have taken how much? 47,250 hours. Clear with this, guys? And what is the standard rate? Every hour you are allowed to pay how much? So what is the standard rate? One second. Yes, standard rate is going to be 4 rupees per hour. Clear with this? That is what we have mentioned here. 4 rupees per hour. It's got repeated. 4 rupees per hour. Clear with this? Now, what is the actual hours paid? It's given in the question. So the actual hours paid is how much? 48,000. So I have paid them for 48,000 hours. Look at this. It's given in the question. One second. Where is it? So the actual hours. Yes. Wages paid, actual hours paid is how much? 48,000, but the actual hours worked was only 47,700. Clearly these 300 hours are nothing but your idle time. Are you clear with this, guys? And what is the actual rate at which I am paying? They have given this figure. They have paid a total wage cost of 1,91,250 for how many hours? 48,000 hours. So per hour, what is the rate? We have arrived at it. Clear with this, guys? First, we have computed all the ingredients. It's just a matter of plug and play right now. So now, labor cost variance, what's the formula? Standard hours into standard rate minus actual hours into actual rate. So now, plug the figures. Standard hours, how much is it? 47,250. 47,250 into standard rate, how much is it? 4 rupees, right? Into actual hours. So actual hours means actual hours paid, 48,000, right? Into actual rate, 3.984375. You need to read in the decimals if you do that. So you should have incurred a total labor cost of 1,89,000, but you've actually incurred how much? 1,91,250. Clearly the actual is more than the standard, which means it's an adverse variance to the tune of 2,250. Are you clear with this? So now this gets bifurcated into 3: labor rate variance, efficiency variance, and idle time variance. Rate variance, standard rate minus actual rate into what? Actual hours paid. So what's the standard rate? I should have paid 4 rupees, but every hour I've actually paid how much? 3.98 something. And how many hours for which I've paid? 48,000. If you multiply that, so basically what has happened? You should have paid 4. You have only paid how much? 3.98 something, which means you've clearly saved some cost for the company. That's a favorable variance. The calculation is this. Clear with the 750 favorable. Efficiency variance, you were allowed to take how many hours? 47,250, right? But you have actually worked effectively for how many hours? 47,700 hours. Clear with this, guys? So basically you have taken what? More time now, and every hour you've taken more, it applies a standard rate of 4 rupees. So basically it's an adverse variance to the tune of 1,800 rupees. And in between you have this idle time variance. What is the idle time? 300 hours. 300 into 4, it's going to be 1,200, and it's always an adverse variance. So now what you do, add up these three and see if you're getting the topmost daddy figure. So now it's going to be how much? 750 minus 1,200 minus 1,800, how much is it? Minus 2,250. It's going to be 2,250 adverse. Clear with this, guys? That is all about it. It is just a matter of arriving at the ingredients. Once you get the ingredients, it is just a plug and play model. Clear with this, guys? Yes, that's about the sum. Fine, that's about this particular part of the question. Next one, variable overhead cost variances. Now for the purpose of variable overhead, once again, we know that the actual output by consuming the variable overhead, how many units were produced? 9450. Clear with this, guys? So what do you need? You need standard hours, standard rate, actual hours, and actual rate. Clear with this, guys? So now, what is a standard hours? Similar calculation. They had given you were allowed to take 60,000 hours to produce 12,000 units. How many hours you were allowed to take for achieving the actual output of 9450? So 60,000 divided by 12,000 into 9450, you get 47,250 is the standard hours that you are allowed to take. Clear with this, guys? And standard rate per unit, how much is this? With respect to variable overheads, it's yes, it's given in the question as 1 rupee per hour. Clear with this? So every hour you spend, every hour is actually the machines are running, you are allowed to incur a cost of 1 rupee per hour. Clear with this, guys? But what is the actual hours worked? We just calculated was the actual hours worked, which is 47,700. Again, this is given in the question, right? And what is the actual rate? Once again, you can easily calculate. How can you calculate that? It's given in the question. The actual variable overhead is how much? 45,000 rupees is incurred, right? So the actual rate per hour is what? 45,000 rupees I've incurred for actually working 47,700 hours. So per hour, what is the actual rate? It's 0.9433. So now what you need to do, just apply the formulas here. Variable over cost variance, standard hours into standard rate minus actual hours into actual rate. Just plug the figures respectively. You'll get, you should have incurred 47,250. You have actually incurred only 45,2250 is a favorable variance. Clear with this, guys? All right. Now this gets bifurcated into two: expenditure and efficiency variance. Expenditure variance, standard rate minus actual rate into actual hours worked. So you should have incurred 1 rupee for every hour. You've incurred only 0.94 something. So basically it's a favorable variance. You can do the calculation, you'll get the favorable variance. Similarly, on the efficiency part, standard hours, you were allowed to incur, you were allowed to take 47,250 hours, but you've taken 47,700 hours, you've taken more hours. Clearly it's an adverse variance. The calculation is as follows. Now once again, you need to check, you add these two. So 2,700 minus 450, you get effectively how much? 2250 favorable. You get the daddy figure, which means that you've done this calculation right. Clear with this, guys? As simple as that. Very, very simple, but you need to get the approach and the logic right. Then we move on to the next one, which is fixed overhead variances. Now, fixed overhead cost variances. What is the actual output? Again, it's going to be 9,450 units. Now, first, let us list out the ingredients. What are the ingredients we need for a fixed overhead variances? Fixed overhead cost variance, you need the absorbed fixed overheads. Absorbed fixed overheads, how will you get it? See, the predetermined rate, standard rate per unit into actual output, correct? So I need all these figures, standard rate per unit, the actual output, then I need the actual fixed overheads. Why the actual fixed overheads comes here? Then I need the budgeted fixed overheads that comes here. Then I need the actual hours and I need the standard rate per unit. All these things we need. If you are able to find out each and every component, then it is just a matter of plugging the figures and arriving at the solution. Now first, what is the predetermined rate? That is standard rate per unit. Very simple. Now go to the budgeted data. They have given what is the fixed overheads. They plan to incur 1,20,000 rupees and they plan to produce how many units? 12,000 units, which means what is the predetermined rate, the absorption rate or the standard rate per unit? It's going to be 1,20,000 divided by 12,000. It's going to be 10 rupees per unit. So 1,20,000 divided by 12,000, it's going to be 10 rupees per unit. What is the actual output? We just calculated. It's going to be 9,450. Clear with this? Then actual fixed overheads given readily in the question, 1,20,900. What is the budgeted fixed overheads? That is also given in the question, 1,20,000. What is the actual hours worked? Once again given in the question, 47,700. Right? What is the actual hours? I mean, it's got repeated here. So basically, I'm striking this off. Actual hours worked, 47,700, and the standard rate per hour. That is also given in the question. Look at this. What is the standard rate per hour? In the budgeted data, they have given the standard rate per hour is how much? 2 rupees per hour. That is also given. Now, guys, don't think it's complicated, right? Most of the data are given here. You just need to know which data to use where. That's all you need to know. Now, what we need to do? Now, just write on the formulas, plug the figures, and you're sorted. That's about it. It's as simple as that. Clear with this, guys? So now let's go here and do this. So now, guys, what is this? So your absorbed overheads, so standard rate per unit into actual output, 10 rupees per unit into 9,450. So I'm absorbing overheads of how much? 94,500, but actual overheads is how much? 1,20,900, which means there is an under absorption, which is actually an adverse variance, gets tracked under adverse variance. How much is that? 26,400. This gets bifurcated into two: expenditure and volume variance. Expenditure variance, budget minus actuals. Well, how much is the budget? Go down, you get each and every figure. Budget overheads 1,20,000. Actual overheads, how much is that? So the actual overheads is going to be 1,20,900. All the figures are given. So I plan to spend 1,20,000, but I've actually ended up spending 1,20,900. So you've spent 900 more. Adverse variance, that's about it. Volume variance is what? Absorbed minus budget, 94,500 minus 1,20,000. You get how much? You get 25,500 adverse. Are you clear with this? Now this gets further bifurcated into two: fixed overheads capacity and fixed overhead efficiency variance. So here it's going to be actual hours into standard rate per hour. The figures are all given. We just calculated the ingredients, plug the figures. 47,700 into 2. Absorbed overhead is 1,20,000. So here the actual hours into standard rate per hour is going to be 95,400, right? Whereas you've spent how much? 1,20,000. So clearly it's an adverse variance to the tune of 24,600. And here absorbed overheads is going to be 94,500, and AH into SR per actual hours into standard rate per hour is going to be how much? 95,400. You subtract the two, you get 900 variance. So now adverse variance. So now you add the two, 24,600 plus 900, you get how much? 25,500 adverse variance. Now you add these two, 900 plus 25,500, you get how much? 26,400 variance. That's all. The entire tree is sorted, and with this we've completed the fixed overhead variances. Guys, it is that simple. Now, what you need to do is first understand the logic, write down the formulas. Number two, from the formulas, what you need to do, list out what are all the ingredients required. Number three, certain ingredients need to be computed while most of the ingredients are readily given in the question. You list it out. Now plug the figures in the respective areas. You will get the answer. Now tell me guys, how is standard costing difficult? How is standard costing difficult? It is as simple as that, and it's very, very logical. Clear with this, guys? And that's about this particular segment of fixed overhead variances. Now, let's move on to the next part, which is sales variances. Now, guys, sales variance is fairly simple. So, how many units were sold here? So, 9,000 units. So, first, let's do it under the total approach. Now, what are the four figures you need? Budgeted quantity, budgeted price, actual quantity, actual price. Now, we know all these figures. Budgeted quantity, how many units I plan to sell? It's given in the question, 12,000 units. It's given, they gave it under the standard data. I told you it's actually the budgeted data. Yes. What was the budgeted price? Now look at this. In the budgeted data, so what was the budgeted sales? 6 lakh rupees, right? 6 lakh rupees is the budgeted sales for how many units? It is the budgeted sales for 12,000 units. So 6 lakhs divided by 12,000 units. What is the selling price per unit? The budgeted selling price per unit, that's going to be 50 rupees. 6 lakh upon 12,000, it's going to be 50 rupees. Actual quantity, how many units were actually sold? 9,000 units. And what is the actual price? So now it's not directly given, but the actual sales figure is given. 4,57,500. Actual units is also given as 9,000. Divide the two, you get the actual selling price. So how much is that? That's going to be 4,57,500 divided by 9,000 units. It's going to be how much? So 457,500. 457,500 divided by 9,000 units, it's going to be 50.8333. Are you clear with this, guys? Fine. Now you have the figures just substituted. Now sales total variance, budgeted quantity to budgeted price, 12,000 into 50. I was expecting to generate a sales turnover of how much? A turnover of 6 lakh, but I actually ended up getting a turnover of only 4,57,500. Basically, my sales has dropped by how much? 1,42,500 rupees adverse. Now, what is the root cause for this? Bifurcated into two, the price and volume variance. Now, budgeted price minus actual price into actual quantity. I plan to sell every unit at 50 rupees, but I ended up selling at how much? 50.83. So I was able to sell it at slightly more. And how many units did I actually sell? 9,000 units. Each of these 9,000 units, I sold it at 0.83 rupees, 833 rupees more. So basically, this has given me a favorable variance. How favorable? Because every unit, instead of selling it at 50 rupees, I've sold it slightly at more, which means every time I sold a unit, I slightly got more than what I expected, looking at it from a price angle. So now basically my marketing manager has done a good job. He has contributed 7,500 rupees more to my profit. Clear with this, guys? Whereas what has happened, the issue happened only on the volume side. The budgeted quantity, I planned to sell 12,000, but I was able to sell only 9,000 units. I sold 3,000 units less, and every unit I planned to sell it at how much? 50 rupees selling price. So basically, because of drop in volume, I sold how many units less? The entire value of sales that got dropped because of my volume was how much? Was 1,50,000 adverse. As simple as that. Clear with this, guys? That is all it is. Now looking at it from a margin approach, now what I need to do, Instead of price, I need to use margin. Now, how will I calculate the budgeted margin? It's the budgeted selling price minus standard cost per unit. Now, sir, what is standard cost per unit? Very simple. Look at this. In my budgeted data, what was the total cost that I planned? I was allowed to incur 5,40,000 rupees of total cost to produce how many units? 12,000 units. So 5,40,000 divided by 12,000. How much is it per unit? What is the cost that you are allowed to incur? 45 rupees. So 5,40,000 divided by 12,000 units, it's 45 rupees. So per unit, what is the budgeted margin? 50 minus 45, 5 rupees. Every time I sell a unit, I am planning to earn how much? 5 rupees. But what was the actual margin? Remember, this is where I told things become different. I told you here, in this case, the calculation is what? Actual price minus standard cost per unit. Actual price is how much? My actual price is 50.83333. Right, but standard cost per unit is 45. So the actual margin ended up to be how much? 5.83333. Clear with this, guys? So now, what is the budgeted quantity? It's 12,000 units. Actual quantity is 9,000 units. So now what you need to do, you need to substitute the figures here and arrive at the answer. So sales margin variance totally, how much is that? So I plan to sell 12,000 units, and each and every unit that I sell, I plan to earn a margin of 5 rupees, but I actually ended up selling only 9,000 units, and every unit I sold actually fetched me a margin of only 5.833. So the profit that I planned for is 60,000, but the profit that I actually got was only 52,500. So this 7,500 rupees is called as the sales margin variance. So basically, because of the sales side, right, because of the issues on the sales side, I have my profit has actually dropped by 7,500 adverse. Now this can be classified into two: sales margin price variance and sales margin volume variance. Price variance is what? Budgeted margin minus actual margin into actual quantity. That gives you, so every time I sell a unit, I plan to earn 5 rupees, but I actually earn 5.833. So every time I sold a unit, I got how much? 8.33 more. It's clearly a favorable variance into what? 9,000 units. It's going to be 7,500. And similarly, the sales margin volume variance is going to be, I plan to sell how much? 12,000 units, but I actually ended up selling only 9,000 units. I sold 3,000 units less, and had I sold each of these units, I would have got 5 rupees of profit. So 3,000 into 5, 15,000 rupees. I lost my profit. So 15,000 adverse. If you knock off these two, 7,500 favorable plus 15,000 adverse, you get what? The daddy comes out to be 7,500 adverse. Clear with this, guys? That is about this particular question. A very, very comprehensive question, but clearly understand, guys, two things that you need to know. Number one, your sales variances are tied to what? They are tied to your units sold, whereas your cost variances are tied to what? Your cost variances are tied to units produced, number one. And number two, when you have a closing WIP with different degree of completion and all, now what you need to do is you need to arrive the component wise equivalent units for material. By consuming the material cost, how many units were produced? By consuming the labor cost and overhead cost, in this case, it was same for labor and overheads, how many equivalent units were produced? That you need to know. And this is, I would call it as the topmost rated sum in this entire chapter. Are you clear with this, guy? And one more thing I wanted to tell you, if you note, the price variance will be the same if whether you calculate it under the total approach or under the margin approach. Under total approach, what is the sale price variance? 7,500. Here under the margin approach, how much was it? It is 7,500. Clear with this, guys? So the price variance alone will be the same whether it's computed under the total approach or under the margin approach. Clear with this, guys? Right? So that is about this entire chapter of standard costing. Right now, of course, this is not a substitute for a regular batch, because in our regular batch we've learned this entire chapter for over 15 plus hours. We've done 50 plus numerical problems, every single adjustment. Here, as the name suggests, we've tried to recapitulate all the major areas, all the variances we have tried to cover, and we have done one flagship numerical problem that is the topmost rated numerical problem. And guys, by the way, the solution for this numerical problem is not correct in the institute study material. Please follow whatever I have just told you, because that is the correct solution. I have proved it in front of you, because in standard costing, even if one small mistake is done, it will not tally. Right? We kept on tallying every single figure, right? We branched it out and we tallied. So clearly this is the right answer. You need not have to worry about it. If this question comes in exam, you can definitely do it in a way in which I have told you right now. Clear with this, guys? So with this, we have completed this beautiful chapter called as standard costing. Now, let's get started with the revision of the next chapter, budgeting. Now, guys, this chapter, budgeting, is a common chapter for paper 8 cost accounting and paper 12 management accounting. In paper 8, this comes under chapter number 16, which is budgets and budgetary control, right? And in our paper 12, it is chapter number 7, forecasting, budgeting and budgetary control. The name of the chapter alone is different, but predominantly around 80 to 90% of the content of this particular chapter is going to be the same for both the papers, right? In our regular batch anyways, we have done it separately, right? I have recorded lectures separately for P8 and P12, but yes, conceptually when we are revising, we can even combine and do it, and that's what we are doing here in the marathon. Now guys, I'm going to call this chapter as budget. I'm just going to give a common name, budget. Now, first of all, before we enter into this chapter, first, our subject, cost and management accounting, has 3 objectives, right? What are the 3 objectives? Stock valuation, profit computation, decision making and control, right? And I told you guys that some chapters in our subjects like P8 and P12 put together, I'm saying some chapters in our subject, right, goes on to achieve the objective A, which is stock valuation, profit computation. Some chapters goes on to achieve the objective B, which is decision making, and some chapters go on to achieve the objective of control. And there are certain chapters which achieve more than one objective at the same point of time. Now, this chapter, budgeting, right, goes on to achieve 2 objectives. One is decision making, the other one is control. Now, sir, how does it go on to achieve the 2 objectives of decision making and control? Now, first of all, right, with respect to how we can say that budgeting helps you achieve the objective of control, yes, you guys can already easily guess this. Let's say I am budgeting that we need to produce and sell 10,000 units in the upcoming financial year or a particular period, right? Now, this is set as a target. Based on this, what happens is the actual performance is being compared, and I can punish or reward the employees based on their performance. We just saw in standard costing also adverse or favorable variance. For that, first we need to set a target, right? So how do you set the target? Based on the budgeting data, budgeted data. So clearly budget helps you achieve the objective of control. That is pretty much straightforward. So now how can you say that budget also helps you achieve the objective of decision making? So this is where I'm going to give you guys one example. Now, let's say at the beginning of a particular period, right? So the board of directors, right, they convened a board meeting, right? That's the right word, convening board meeting, company law word, right? So they convened a board meeting, right? And in the board meeting, they had to discuss one very important issue. What is it? For the upcoming financial year, right, the company had 2 alternatives. One, right, anyways, they wanted to maximize the profit. They wanted to increase their sales, right? Now, there are 2 ways to increase the sales amount as a whole. One group of board of directors are saying you reduce the selling price per unit. If you reduce that, the law of economics will work in your favor. The volume will increase. Because of the increased volume, overall the sales value will be high, because of which you can achieve your profit, right? There is another set of directors in the same board meeting who are saying no, don't do that. In fact, you should increase your selling price. Now our product will be costly. That's okay, fine. The volume will be less, but every time I sell a unit, I'll be getting more selling price. This way I can make more profit. Now, these are the 2 alternatives put forth in the board meeting. Now, you tell me guys, which one is better? Now, we can't directly conclude by saying, so option 1 is better or option 2 is better. So what the company does is, at the time of preparing a budget, what they do is, they take into account all these alternatives. For each and every alternative, they calculate the profit, and whichever alternative gives the maximum profit, they will take that and set it as a budget. Or in other words, fixation of a budget itself requires decision making between multiple alternatives. This way, your budgeting chapter also helps you achieve the objective of decision making. Are you clear with this, guys? Yes. So now this is what this chapter says, right? So budget is basically a plan of action as well as a target. A plan of action because it helps you achieve the objective of decision making, and a target because it helps you achieve the objective of control. Clear with this, guys? Now, predominantly in this chapter, this budgeting chapter, right, is bifurcated into two segments. One is preparation of something called as functional budgets. The other one is preparation of something called as flexible budget. Broadly, if we want to categorize, these are the two components inside this particular chapter: functional budgets and flexible budgets. Functional budgets, the concepts involved here are similar to the one that you would have studied in paper 8, cost accounting. There is a chapter called as cost sheet. If not, it's still fine, right? And here the flexible budget concepts revolve around the concepts of marginal costing. Like, it revolves around your variable cost, fixed cost, and your segregation of semi-variable cost into fixed and variable, right? Some basic common sense driven area. With that, you can finish off easily this particular chapter. Now, guys, I have even told this in a regular batch, which I'm telling once again in this revision marathon series. Now, guys, if I were a student, I would always revise this particular or prepare really well on this particular chapter, budgets, especially in paper 12, because in terms of complexity, this is the least complicated chapter, or in other words, it's slightly easier than the other chapters. Number one. Number two, this chapter alone contributes to 15% weightage as per our CMA Institute, the weightage, chapter wise weightage that they have given. So it's an easy chapter to learn, and at the same time it has a huge weightage in the exam. I would anytime prefer revising this particular chapter and give more importance to this chapter. It's easy way to score more in the exam also. Clear with this, guys? Right now, on that note, let's get started with the first segment of this particular chapter, which is called as functional budget. Now, functional budgets, what do you mean by functions? Right? Your every single activity happening in the organization. Basically, if you prepare budgets for every single function in the organization, right? Sales budget, your production budget, your material budget. In material, you can have material purchases budget, material consumption budget, your production overhead budget, overhead budget, and so on. Clear with this? Preparation of budget for every single functions in the activity is called as what? Is called as functional budget. Now, these are the list of functional budgets we've got: sales budget, production budget, direct material budget, direct labor, POH budget, AOH budget, SOH budget, advertising cost budget, R&D budget, CapEx, capital expenditure budget, your cash budget, your master budget, and so on. Clear with this, guys? Right now, technically speaking, your capital expenditure, your cash budget and all, this forms part of your financial management, right? But predominantly the other components form part of our subject only, cost accounting and management accounting, as the case may be. Now, one very, very important thing that you need to know is, when you are preparing the budgets, directly you cannot jump into any budget that you want. No, first and foremost, you need to prepare the sales budget. Once you prepare the sales budget, then you necessarily need to prepare production budget. Clear with this? After preparing production budget, then all other budgets you can prepare. Are you clear with this? So always remember, first you need to know the sales budget, then you need to, with that you should prepare the production budget, and only after that you can prepare all other components of budgets. Now, sir, why is it like this? Why is it like this? Always remember, in an organization, the planning activity starts from the sales activity. The planning activity, the planning function starts from the sales activity. Now, let me give you an example. Now, let us say a company is planning to sell 1 lakh unit in the upcoming financial year, or let's say in a particular period, right? They are planning to sell 1 lakh units, right? So 1 lakh units they want to sell. Not just that, apart from that, they are planning to keep a closing stock of how much? 20,000 units, right? Now, if you look at this, you'll be able to understand this. Now, look at this here. Now, so basically, how much the company produce and keep, right? So they are planning to sell 1 lakh units that need to be produced. Apart from that, they are saying you need to produce and keep as a stock 20,000 units. So overall, I need to produce how many units? 1,20,000 units. But wait, they have also given one more data. The company already has an opening stock of 10,000 units, which means you need not produce 1,20,000. Out of this, 10,000 is already produced and you already have it in your opening stock. So you reduce that. So if you net off these three, you get what? The number of units to be now produced in the upcoming period. Are you clear with this? Or in other words, the first starting point was sales. So they said you need to produce 1 lakh units plus produce and keep 20,000 units as a closing stock, right? So sir, I need to now produce a total of 1,20,000. No. Wait, you already have 10,000 units in your stock. Reduce that. So net off right now, you need to produce only how many units? 1,10,000 units. Are you clear with this, guys? Now, let us say to produce 1 unit of my FG output, I require 2 kgs of raw material, right? Now, how many kgs of raw material will be consumed in this year? I need to produce 1,10,000 units, right? And every unit will consume 2 kgs. It's going to be 2,20,000 kgs. Are you clear with this? So now let me just put it here. So the raw material consumption will be how much? 1,10,000 units I need to produce, and every single unit is going to consume how many kgs? 2 kgs. So now it's going to be how much? 2,20,000 kgs is what I need to total raw material consumed. Now, apart from this, the company says you should always maintain a raw material closing stock of 30,000 kgs. So 2,20,000 plus 30,000. So the company has a total raw material requirement of how much? 2,50,000 kgs. But wait, they are also telling you that now, anyways, the company already has an opening stock of 50,000 kgs. So now, how many kgs need to be purchased now? So it's very clear. 2,20,000 plus 30, 2,50,000 I require. Out of this 50,000 I already have. So you net off these three, you get what? The balancing figure as the raw material purchase requirement, which is 2 lakh kgs in this case. Are you clear with this, guys? Now let us say this is called as what? Raw material purchase budget. That's all. Very simple. Now let's say every kg of raw material should be purchased at how much? The purchase price is 10 rupees. So now what is the total raw material purchase budget in value? It's going to be 2 lakh rupees into 10. That's going to be 20 lakh rupees. As simple as that, guys. Are you clear with this? It's very simple. So now if you see, what was the starting point? First, you need to have the sale figure. Once you have the sale, with that you can arrive at the production. Once you have the production, with that you can find out the raw material consumption. Once you have the raw material consumption, with that you can find out the raw material purchase. It's a chain that follows. Are you clear with this? Similarly, let me take one more example. Wages budget, right? Now, let us say to produce 1 unit, I require 2 hours of labor. So now in the upcoming year, I'm planning to produce how many units? 1,10,000 units, which means I need a total labor of how many hours? 1,10,000 hours into 2, 1,10,000 units into 2 hours. That gives me how much? 2,20,000 hours I need, right? Let us say every hour I'm going to pay them at a rate of how much? 10 rupees. So overall, what should be my raw material? What should be my labor cost budget? It's going to be so 2,20,000 hours into 10. That's going to be 22 lakh rupees. Are you clear with this? Suppose they are saying how many people you need to recruit. How many people you need to recruit? Now let us say I need a total of 2,20,000 man hours in a year. If I employ one person, he can work for 2,000 hours, right? So which means how many workers I need to employ? 2,20,000 divided by 2,000. I need to hire how many people? 110 workers. Are you clear with this? So now with this, any kind of budget can be prepared. These are all workforce or labor or wages budget. Are you clear with this? So similarly, it just goes on. Every single component of this budget can be prepared based on the data available. But always remember, first start from sale, then it goes on to production, and only then the other cost components can be prepared. The other cost components, the other budgets, the other cost component related budgets can be prepared. Are you clear with this, guys? Right now, in some cases directly they would have given the production. In that case, you need not go to prepare the sales budget, and all the figure itself would have been given. If the figures are directly given, it's fine. Clear with this, guys? Now sir, what do you mean by master budget? This master budget is nothing but budgeted profit and loss statement. So here what you will be having is, here you will be having the budgeted sales, right? And all the cost budgets will be here, right? So material cost budget, labor cost budget, POH, AOH, all these things will be there. And finally, you will be having budgeted profit. Now in this master budget, all the other functional budgets will be coming as a working note. There you will do the workings and post it here in this budgeted P&L statement. Are you clear with this? So a master budget is nothing but a comprehensive budget that covers all the other budgets using which you can prepare your budgeted profit and loss statement. Clear with this, guys? So that is the entire story about what? That is the entire story about functional budget. Now let us do a few numerical problems here. So we will be doing two numerical problems in this area of a functional budget. Then we will move on to flexible budget. We will do one numerical problem. With that we will be covering predominantly the most important concepts in this particular chapter. Right. Now let's move to one numerical problem. One second. Right. So this is the handbook we use in our regular lectures. Right. So one second. I'm taking question number. Yes. First we will do one raw material purchase budget. Now look at this. From the following figures, prepare a raw material purchase budget for Jan 2021. Now, in this case, what they have mentioned is the company uses 6 different types of raw material A, B, C, D, E and F. What they are saying, they are asking us to prepare a raw material purchase budget for the month of Jan. So, how many units or kgs of raw material needs to be purchased? They have given opening stock, estimated opening stock, each of the different raw material, each of the different types of raw material. They have given the opening stock value. How much is going to be the closing stock? How much is going to be the estimated raw material consumption, that is also given, and what is going to be the standard price per unit of raw material. Now, first what we need to do, get raw material consumption plus closing stock. That's going to be the total raw material requirement minus opening stock. That is going to be your raw material purchase. So you will get it first in units, multiply it with the respective cost. Now you will get what? The raw material cost budget. As simple as that. That's about it, guys. Clear with this? Now look at this. So first, estimated consumption. So what they have done, raw material consumption they have first taken, right? Raw material consumption. So whatever is the figure, 1,20,000, 44,000, 132, 36, 88 and 1,72,000. Total you cannot do. Why? Because these are different types of raw material. These different types of raw material cannot be added, right? It is like saying how much is 5 apples plus 4 mangoes. So it is 9 what? You cannot add different dissimilar items. So it cannot be added here. So first raw material consumption. Then they have added the opening stock. Now they have arrived at what? The total raw material requirement. So now should I purchase everything? Wait. I already have an opening stock, right? So you subtract that here. So once you subtract that, you will get what? The raw material that is required to be purchased here. So number of units of raw material that is required to be purchased. Ideally speaking, this should not be added here. Clear with this, guys? So now, I need to purchase 1,24,000 units of raw material A, 46,000 units of raw material B, 136,000 units of raw material C, 38,000 units of raw material D, 90,000 units of raw material E, and 1,76,000 units of raw material F. Now, multiply this with the rate per unit, right? So how much is the rate per unit? It's given in the question as 0.25, 0.05, 0.15, 0.10, 0.20 and 0.30. The rate per unit of raw material has been given here, right? So now what we need to do is, so let's say this is A, this is B. So you just need to multiply the two. So the number of units to be purchased multiplied with the rate per unit. So now the raw material purchase cost for raw material A is going to be how much? 31,000. B, 2,300. C, 20,400. D, it's 3,800. E, it's 18,000. And F is going to be 52,800. This can be added as a whole. Why? Because now I've converted everything into rupees. So now it's going to be how much? 1,28,300. So now I can clearly plan for my raw material purchases. So in this period, I need to prepare myself for to the tune of 1,28,300 rupees for the purpose of raw material purchases. Are you clear with this, guys? This is exactly what this particular question talks about. And this question was about what? Functional budget with respect to raw material purchases. Now let's move on to the next question, right? So this question is regarding what? Your manpower or your direct labor budget. Now let me just quickly walk you through this. A factory works 8 hours per day, 6 days a week, and the budget period is 1 year. And during each quarter, the lost hours due to leave, holidays, and other causes are estimated to be 124 hours. Clear with this, guys? This is what they have given. Now, the direct labor per unit, they have given it as follows, right? So, the company has two departments, Department P, Department Q, and the company deals in two products, product A, product B, right? Be very careful. The company has two different departments and they have two products. Both the products will pass through both the departments. For example, product A, it spends every unit of product A spends 2 hours in department P and 1 hour in department Q. Are you clear with this? And if I am using this department P, right, for manufacturing product A, right, the per hour labor cost is 1 rupee. Whereas in department Q, to manufacture every hour, for every hour spent on product A, the charge is how much? It's going to be rupees 3. Similarly, product B also passes through P and Q. It spends 1 hour in P, 1 hour in Q. The rate is rupees 2 and rupees 3 respectively. The number of units to be produced as per the production budget. Now, we need not prepare the production budget. The production budget data is given. So, they have said that you need to manufacture a total of 10,000 units of A and 4,000 units of B. Now, prepare a manpower budget showing the direct labor hours, right, and the number of workers, and the manpower budget showing the labor cost. So, basically, three things they are asking: total labor hours required, total number of workers required, and the total labor cost that you are planning to incur. Three things they are asking us. Now, very simple. Now, look at this. It's pretty much straightforward. Now, first of all, look at this. Department P, Department Q. There are two departments where, the laborers are working. Now, first, let us budget the total number of hours required. Now, in Department P, both the products A and B will pass. Now, for the purpose of manufacturing product A, how many Department P hours are required? So, product A, every unit of A spends 2 hours in Department P, right? And I'm going to produce a total of 10,000 units. So, 10,000 into 2, how much is it? So, in Department P, for producing product A exclusively, I needed 20,000 hours. Similarly, so Department P also processes product B. 4,000 units of product B are being processed, and every unit of product B spends 1 hour in Department P. So it's going to be 4,000 into 1. So I need 4,000 hours in Department P exclusively for the purpose of manufacturing product P. So tell me, guys, the total number of hours required in Department P is going to be how much? It's going to be 24,000 hours. Clear with this, guys? Next, Department Q. Now, once again, Department Q also processes both the products A and B. So, for the purpose of producing product A, how many hours are required in Department Q? 10,000 units into 1, it's going to be 10,000 hours. Now, how many hours in Department Q are required for the purpose of manufacturing product Q? For the purpose of manufacturing product B, it's going to be 4,000 units into 1. That's going to be 4,000 hours. Clear with this, guys? So now I need a total of 14,000 hours in Department Q. So as a whole, in Department P, I need 24,000 hours, and in Department Q, I need a total of 14,000 hours. Are you clear with this, guys? Now, first we have answered the first part of the question, which shows that how many direct labor hours are required. Now, how many workers are required? That we need to calculate. Now, in this question, they have mentioned that if you are making one guy work, right, every worker, right, he will work for 8 hours in a day, right? Like that, he will work for 6 days in a week, right? This is what they are saying, right? So this is about a week, and in a year, how many weeks are there? 52 weeks are there. So one worker can work for a total of so many number of hours. But wait, they have also mentioned something. In every quarter, 124 hours he will not be working. So out of this, minus 124 is the number of hours lost per quarter. How many quarters are there in a year? So there are 4 quarters in a year. Clear with this? So every worker works for how many hours in 1 year? So it's going to be 8 into 6 into 52, which is going to be 2496, minus 124 into 4. How much is that? 496. So technically speaking, every worker, if you hire one guy, in a year, he can give how many hours? He can work for how many hours? 2000 hours, right? So now one worker can work for how many hours? 2000 hours, whether he is working in department P or in department Q. In department P, I need a total of 24,000 man hours. If I hire one guy, he will work for 2000 hours, which means how many workers I need to now hire? So 24,000 divided by 2000, it's going to be 12 workers. I need to hire 12 workers in department P. Are you clear with this? Similarly, in department Q, so I need a total of 14,000 man hours, but if I hire one person, he will be able to work for how many hours? 2000 hours. So 14,000 divided by 2000, it's going to be 7 workers. Are you clear with this? So with this, we have also arrived at what? The total number of workers required. Clear with this, guys? Now, the final part of the question, which talks about what? Which talks about what is going to be the total number of, what is going to be the total labor cost in this particular in the upcoming period, right? So the manpower budget showing the labor cost. This is what we are going to do. Now, guys, please be very clear. Please be very clear. See, department P, right? For producing product A, for every hour, the worker in department P, if he is working on product A, the cost is 1 rupee. Whereas if the same department P guy is working on what? Product B, the cost is going to be 2 rupees per hour. Are you clear with this? So there is a differential rate within the department itself. So we clearly need to do it accordingly we need to do it. So how do we do it? Very simple. Department P, we just found out in department P, I need 20,000 hours in total for producing A and 4,000 hours for producing B. Right? So 20,000 hours for A, 4,000 hours for B. Similarly, in department Q, I need what? 10,000 hours for A and 4,000 hours for B. 10,000 hours for A and 4,000 hours for B. Now, in department P, for every hour I work on product A, I incur a cost of how much? 1 rupee. Whereas if I'm working on product B, I incur a cost of 2 rupees respectively. So put it here, 1 rupee and 2 rupee respectively. Whereas in department Q, right? So if I'm working on, for every hour I work on product A, I incur a cost of 3 rupees, right? And even if I'm working on product B, I incur the same 3 rupees. So I can put this 3 rupees here. Are you clear with this? So now what we need to do, it's just a matter of multiplication. So 2000 into 1, 20,000, sorry, 20,000 into 1, 20,000, 4,000 into 2, it's going to be 8,000. So now the total department P cost is going to be how much? 28,000 rupees. I'm going to incur a total labor cost in department P to the tune of 28,000. Similarly, in department Q, it's going to be 30,000 plus 4 into 3 is going to be 12,000. So 30 plus 12, it's going to be how much? 42,000. So now in department Q, I'm going to incur a total labor cost of how much? 42,000 rupees. Are you clear with this, guys? Right? Now, what is going to be the overall labor cost that you can budget? Just add the two. So how much you get? 28,000 plus 42,000. That's going to be how much? Rupees 70,000. So 70,000 rupees is the overall labor cost I need to budget for the upcoming period. Are you clear with this? See how simple this is. 3 things we found out. First, how many labor hours we require in each department, number 1. Number 2, totally how many workers we need, that also we found out. And number 3, what is going to be the budgeted labor cost department wise? Since it is in rupees, it can also be added as such. Are you clear with this? Right? That is all about this particular area called as workforce budget. And the other parts are also like we have POH budget, AOH budget, SOH budget. All these things we generally do it in the regular batch, but predominantly your raw material and wages, these are the budgets that are quite important in terms of concept coverage. So I picked these 2 numerical problems for the purpose of discussing our flexible budget. For the purpose of discussing our concept of functional budget. Are you clear with this? Now, with this, now let's move on to the next concept called as flexible budgets. Now, in this concept of flexible budget, right? So, what do we have here? In flexible budget, right? Basically, this area revolves around the cost behavior pattern. So, when I say cost behavior pattern, we are talking about your variable cost and fixed cost. Now, guys, you tell me, what is the nature of variable cost? Variable cost remains constant on a per unit level, whereas fixed cost remains constant in total. Correct? For example, let us say they have given, right, at a volume level of 10,000 units, at a volume level of 10,000 units, right? Let us say the variable cost is equal to, let's say it is going to be 20,000 rupees, right? And the fixed cost is equal to how much? Let's say 15,000 rupees. Just an example, right? Now they are asking you, so now what is the total cost here? The total cost is going to be 35,000 rupees, right? Now they are asking you, prepare a budget, prepare a budget when the volume level is going to be 20,000 units, when the volume is going to be 20,000 units. Now when the volume doubles, will my total cost also double? Can I say, okay, so if at 10,000 units level my cost is how much? 35,000. So if my volume is doubling to 20,000 units, my total cost will also double and become 70,000? Absolutely not. Why? So now we've seen this, these are basics of our cost behavior pattern, variable and fixed cost. Look, variable costs will move in proportion to your volume, whereas fixed costs is, as the name suggests, it remains constant in total. It will not change based on your volume level. Clear with this, right? So now in this case, what I will do, for me to prepare the budget for any other volume level, right, what I will do is, for the given volume level, right, I will present the variable cost on a per unit level, fixed cost on a total level. If I have this for any different volume level, I can prepare the budget. Now the budget given here in the question is called as a static budget, right? And the budget that we now need to prepare for a different output level is called as a flexible budget. So we are flexing the static budget and preparing whatever is the budgeted figures for the given volume level. Now in this case, what we do here is, look at this. So 20,000 rupees is what my variable cost, right? If my volume is how much? When my volume is 10,000 units. So what is the variable cost per unit? The variable cost per unit is going to be rupees 2 per unit, right? So variable cost makes sense only if it is represented on a per unit level, and fixed cost makes sense only if it is presented in total. Are you clear with this? So now what will I do? For a volume level of 20,000 units, immediately I will prepare two column, per unit column and amount column, right? Here I will write down variable cost and fixed cost. Immediately what will I do, right? For this 20,000 units column also, the variable cost will continue to be 2 rupees on a per unit level. It remains constant on a per unit level, whereas the fixed cost will be constant in total. So fixed cost, I will fill in the total column. Clear with this? Now I can prepare the other one. So what is going to be the total variable cost for this particular 20,000 units level? 2 into 20,000, it's going to be 40,000 rupees. Right? And what is going to be the fixed cost per unit? Representatively, if you want, you can just mention it. So it's going to be how much? Okay, I've mentioned 1,50,000 here. Okay, it's 15,000 divided by 20,000. How much is it? It's going to be 0.75. Are you clear with this? Yes, it's going to be 0.75. So now in this case, at 20,000 units output level, my total cost is going to be how much? 55,000 rupees. Are you clear with this, guys? Right? Are you clear with this? So now basically this is all about the concept of flexible budget. So in flexible budget, what do you have here? So you need to know that variable cost needs to be constant. Variable cost is constant on a per unit level, fixed cost is constant in total. So now variable cost makes sense only if it is presented on a per unit level, fixed cost makes sense only if it is presented in total. So now for a given output level, that is a static budget, you convert the variable cost on a per unit level, convert the fixed cost in total level, and for any volume level, you first fill in variable cost on a per unit column, fixed cost in total column. The other column respectively can either be multiplied or divided and arrived by. Clear with this, guys? This is all about the concept of flexible budget. So now we will be doing one numerical problem in this regard also. Now we'll do this question. It's actually problem number 12 of our regular batch handbook. With the following data for a 60% activity level, prepare a budget for production at 80% and 100% capacity. The production at 60% capacity is 300 units. Now, what have they given? Presently, the company is operating at 60% capacity. At 60% capacity, they are able to produce 300 units, which means at 100% capacity, if the company is operating at 100% capacity, right, what will be the total number of units the company can produce? 300 upon 60 into 100. How much is that? That's going to be 500 units. Clear with this, guys, right? And if the company is operating at 80% capacity, how many units can they produce? So it's going to be 80% of 500. That's going to be 400 units. Clear with this, guys? Now, what they have given? They have given some cost data at 300 units output level. They are asking you to prepare a flexible budget, right, when the company is operating at a volume of 400 units and when the company is operating at a volume level of 500 units. Clearly, this is a flexible budget scenario. What have they given? At 300 units capacity level, that is 60% capacity level, the material cost is what? 100 rupees per unit, labor 40 rupees per unit, expenses 10 rupees per unit, factory expenses, they have given a bulk figure 40,000, out of which 40% is fixed and the balance 60% is variable. So now 40,000 rupees, right, out of this fixed variable, let us segregate this. How much is fixed? 40%. How much is variable? The balance 60%. So now tell me, guys, 40% of 40,000, how much is that going to be? 16,000 rupees, right? And the balance 60%, how much is it? 24,000 rupees. Are you clear with this, guys? So now this factory expense 40,000 rupees, single figure they have given, right? So now you can bifurcate it. They have given 40% is fixed, so 40% and 40,000, 16,000 rupees is fixed, and the balance 60%, which is 24,000, is going to be variable component. Similarly, admin overheads they have given it's going to be 30,000 rupees is the total admin overheads. Out of that, 60% is fixed. So now what do you have here? Similarly, so how much is the fixed component? 60%, which means the balance is going to be the 40% is going to be your variable component. So 60% of 30,000, how much is it? 18,000 rupees is going to be your fixed component, and the balance 12,000 rupees is going to be your variable component. Clear with this, guys? So now this is the data they have given. This is the data they have given us, right? Now, what do? First, you need to identify which are all the variable costs, which are all the fixed costs. Now, you guys tell me. Material costs, it is clearly variable. Labor, this is variable. Expenses, direct expenses, this is also variable. Factory expenses, now variable costs, you need to calculate it on a per unit level so that it will be easy for you. Readily you will be having the figures. You just need to multiply with the respective volume level. You can prepare the flexible budgets. So these are all readily available on a per unit level, right? Here factory expenses, fixed component that we need only on a total value level, which we have 16,000. The variable component of factory expenses, 24,000 rupees is the amount for 300 units output level. So 24,000 divided by 300, how much is it? So I can say this is nothing but rupees 80 per unit. We have calculated this also, rupees 80 per unit, correct? This 24,000 rupees of variable factory expenses is pertaining to an output level of 300 units. So divided, you will get what? 80 rupees per unit. So the variable factory expenses 80 rupees per unit. Similarly, admin expenses, the fixed component is 18,000. This remains constant in value, whereas the variable component 12,000 is pertaining to what? An output level of 300. So 12,000 upon 300, how much is that? That's going to be rupees 40 per unit. So I will mention this as rupees 40 per unit. Are you clear with this? So now all the variable costs we have right now, the figures we have it on a per unit level, right? And all the fixed costs we have the figures on a total level. With this, you can prepare the budget data for any given output level or any given volume level. See, this is what they have done here. So, right, at 3,000 units level, 300 units level, that is 60% capacity, 400 units level, 80% capacity, 500 units level, 100% capacity. These are three scenarios, right? So now what they have mentioned, they have listed out the components of cost. Material costs, 100 rupees per unit, labor cost, 40 rupees per unit, expenses, 10 rupees per unit. Now variable factory expenses, So the variable component 80 rupees per unit, they have mentioned it here. Similarly, the variable admin expenses, it is going to be 40 rupees per unit. This is also something they have mentioned. So these are all the variable cost components. Fixed costs, there are two fixed costs. Fixed factory cost 16,000 rupees. They have mentioned here, this remains constant in value. Irrespective of your output level, fixed cost remains constant in total. Similarly, your fixed admin expenses, how much is that? 18,000 rupees. This also remains constant in value irrespective of your volume level. Are you clear with this? So now what you have got, all the variable cost components you've got on a per unit level, right? Multiply it respectively with the output. So now here it's 100 rupees, 100 into 300, 30,000, 100 into 400, 40,000, 100 into 500, 50,000. Clear with this? So in a single shot, you've got all the three figures, material cost for each and every output level. Similarly, labor cost, 40 into 300, 12,000, 40 into 400, 16,000, 40 into 500, 20,000. Similarly, expenses, what you get? 10. So 10 into 300, 3,000, 10 into 400, 4,000, 10 into 500, 5,000. Variable factory costs, you have what? 80 rupees into 300, it's going to be 24,000. 80 rupees into 400, you get 32,000. 80 rupees into 500, you get 40,000. Similarly, here it's going to be 40 rupees, your variable admin expenses. 40 into 300, it's going to be 12,000. 40 into 400, it's going to be 16,000. 40 into 500, it's going to be 20,000. So now you have the cost data for all the output level, all the volume level. You just need to total it up. You will arrive at the total cost for each and every output level or each and every volume level. This is called as what? This is called as flexible budget. So basically, the budgeted data given here is called as a static budget. And using the ingredients given in the static budget, right, if you prepare the budget for different output levels, that is called as a flexible budget. How will you do that? Very simple. First, you segregate which are all the variable components, which are all the fixed components. Variable components, you arrive at the variable cost per unit. Fixed components, you arrive at the fixed cost in total. If you have this readily, any output level, you can prepare the budget. Are you clear with this? And that is the concept of flexible budget. Are you clear with this, guys? And with this, we have covered this revision of this entire chapter called budgets and budgetary control, right? So this is all about this chapter, guys. This is all about this chapter predominantly, right? Of course, there are some intricacies involved and all, like multiple adjustments, which we have seen in our regular batch. But for the purpose of revision, overall, this is what this particular chapter talks about, right? With this, we have finished this beautiful chapter called as budgets. Now guys, let us start with the next chapter called as activity based costing. Now this chapter ABC is nothing more than an extension of the previous chapter overheads. That is all about it, right? That is all about it. So this chapter ABC, as I just said, is an extension of overheads, right? Now in this chapter, what we are going to do here, chapter 3, your ABC, this chapter, the objective of this chapter is to calculate the overhead cost per unit. Overhead cost per unit. Sir, you said this was the objective of the previous chapter also, that is overheads. This chapter also, once again, you are saying the overhead, the objective of ABC is to calculate the overhead cost per unit. Why do we need two chapters doing the same objective? Now let me tell you this. Now in the previous chapter, overheads, absorption costing system, that is traditional, it's called as a traditional costing system, right? ABC is basically your modern way of dealing with overheads. It's a modern costing system. In overheads, what we did, first we had items of overheads, correct? We have multiple line items of overheads. Now what we did, first we did a primary distribution. That is, we distributed the overheads to all departments, P1, P2, P3, S1, S2 and all we did, right? Then what we did, this production, the service department overheads were redistributed back to the production departments. That was actually done under the secondary distribution. At the end of secondary distribution, you had only P1, P2, P3 and all, right? And finally, we did something called as absorption, and we calculated the overhead cost per unit of A, B, C, D, etc. the products. Clear with this? This is what we did. This is what we did. Correct, guys? Now, this chapter ABC says the starting point for this chapter is also line items of overheads. The destination of this chapter is also to calculate the overhead cost per unit of every product that the company is manufacturing. What this chapter says is, we are agreeing with the starting point, we are agreeing with your ending point, but we do not accept the journey that you are doing. That is your primary distribution, secondary distribution. This journey has a huge flaw in it. It has a huge flaw in it. What is it is what we are going to study here in ABC. Clear with this, guys? Not much of any discussions, any intricate discussions like under absorption, over absorption. No, the root alone, how it should be different is what we are going to learn here in ABC. Clear with this, guys? Now, first, in our traditional costing, the previous chapter, overheads, what we saw was there are line items of expenses like your factory rent, right? You had your factory rent, your supervisor's salary, you had your repairs and maintenance, you had your depreciation, and so on. It just went on. Now, what we did, we apportioned each of these line items to all the department cost, all the departments. Correct, guys? Now, why did we do that? Because we did it because we said overheads was telling us that, look, the reason why you are incurring the cost is because you have these departments, right? So, apportion all your costs to each of these departments. So now, because you are incurring these costs for the departments only. Are you clear with this? This was the logic given by what? Given by overheads. Now, this is where your ABC clearly disagrees. It says, look, you are not incurring overheads, or you are not incurring these expenses because you are having the department. You are incurring overheads because of the activities happening inside every department. I'm repeating. ABC says the presence of this department, P1, okay, then it means you are going to incur some expense. No. P2, expense. No. The presence of the department is not the reason for you to incur expense. There are activities that are getting done under every single department. It is the activity because of which the cost is being incurred. Or in other words, ABC says, because you have activities, right, it results in consumption of resources, and consumption of resources results in incurrence of costs, and hence apportioning the cost to the departments by giving a justification that the presence of department is the reason why I'm incurring the cost is absolutely incorrect, right? Ultimately, we are also going to find out only the overhead cost per unit, but the manner in which we are going to do, we are not going to route it through departments. Instead, we are going to route it through activities. That is what ABC is saying. Are you clear with this, guys? Are you clear with this, guys? Right. Now, what does ABC say? What does ABC say? Now, look at this. Look at this. We saw one previous example, right? Wherein we saw the concept of your blanket overhead rate versus departmental rate. Guys, yes, you guys remember this, right? Now, there we saw clearly that a departmental rate is much superior and better than a blanket overhead rate. Why? One of the reasons we saw was, right, if I am using a departmental rate, I have the flexibility to choose the base quantity which is more relevant for that department. Correct, guys? Guys, please reciprocate. Yes, you guys are following here, right? In other words, here, if P1 is a machining department, it makes more sense to apportion the P1 department cost using machine hours. Right? If P2 is actually a labor department, an assembly department, it makes more sense to apportion P2 department overheads using labor hours. Clear with this, guys, right? So we saw that our departmental rate is much better than your blanket rate. Now ABC says even that departmental rate is also not correct. Why? Let me give you an example. Now what happens is, let us say I have a factory. So let us say we are using departmental overheads only, right? Let us say there is one department P1, there is one department P2, there is one department P3, right? Now P1, let us say, is a machining department. Okay, now what happens? Let us say the machining department's overhead cost was 1 lakh rupees. I'm just talking about this single department, right? Blanket rate anyways is bad. No, we saw in overheads chapter the departmental rate is better. But ABC is further saying, wait, departmental rate is also not correct. Why? If you are using departmental rate, what will you do? This 1 lakh rupees, right? You will divide it by the machine hours spent in this department, arrive at the machine hour rate, use that as an absorption rate. Correct? Yes. Now they are saying, wait, don't blindly go based on department. Further dig deep into this. Now in this P1 machining department, there are actually 3 activities happening. Okay. One activity, the first activity is called as machine running activity. Then you have one more activity called as setup activity. Then you have something called as inspection activity, right? Now they have found out that yes, in department P1 there are actually 3 activities that are happening, and the machine running activity, right, is actually incurring a cost of 60,000 rupees. The setup activity is actually incurring a cost of 15,000 rupees, and the inspection activity is incurring a cost of 25,000 rupees. Or in other words, the breakup of this 1 lakh is further broken down into activity wise. Are you clear with this, guys? Now if you see, it will all make sense. Now what has happened? Departmental rate was actually absorbing the entire 1 lakh rupees by taking machine hours as the base quantity. But technically speaking, if it is now broken down into multiple activities level, now you can see that only 60,000 rupees is driven by machine hours. Correct? Only 60,000 rupees is driven by machine hours. Setup activity cost of 15,000 rupees is driven by some other cost driver. Maybe that could be the number of setups. What do you mean by a setup activity? Let us say I'm starting a class. I'm doing a class here right now. Okay, right? Now, the moment I start a class, right, I need, before the start of the class, I need the setup to be done. The camera should be turned on, the light should be turned on, and all these recordings and all these streamings, everything should be done. Correct? Now, let us say that I am going to take a class for 2 hours, right? Let us say I'm going to take a class for 2 hours, right? On day 1. On day 2, let us say I'm going to take a class for 8 hours. Now you tell me whether I'm taking a class for 2 hours or I'm going to take a class for 8 hours, the setup cost or the setup activity will remain the same. Correct, guys? Or in other words, this setup cost or the setup activity cost is not driven by the number of hours, it is driven by the number of times I do the setup activity. Clear? So this 15,000 rupees is driven by a completely different cost driver. Are you clear with this? And this inspection, it has nothing to do with my machine hours. This inspection activity maybe is driven by the number of inspections carried out. Are you clear with this? So technically speaking, what activity based costing says is, look, even your departmental rate is wrong. It says if the name of the department is machining department, absorb everything based on machine hours. No, further break it down into activity level, activity wise find out what is the factor that drives the cost, keep that as the base quantity to arrive at your absorption rate. Are you clear with this, guys? Are you clear with this? That's why here we don't actually use departments as the basis for actually apportioning the cost. We further break it down into activity, and activity wise we find out the factor that drives the cost, right? And now it makes more sense because now the manner of apportionment will be much more meaningful. Are you clear with this, guys? Are you clear with this? This is exactly what ABC says. So what they are saying is, first list out the activities, right, and find out the activity wise cost, right? That activity wise cost is called as a cost pool. Pool means what? Collecting things together. It's called a pool. Clear with this? So activity cost pool means the activity, that particular activity's amount, cost amount that you are incurring. Clear with this? Then find out the cost driver, that is nothing but your base quantity, right? And arrive at your cost driver rate. This is nothing but the absorption rate that we saw there. Are you clear with this? Now, if you do it like this, it is going to be a much more meaningful manner of apportioning your indirect cost to the products. Are you clear with this, guys? This is all ABC says. That's about it. ABC chapter is over. That's all. Now, let us go and do the numerical problems. You will see it by yourself. Clear with this, guys? And of course, the terminologies alone will be slightly different. There, whatever we call as department, here these guys call it as activity. There, what we call as base quantity, here it's being called as cost driver quantity. There, what we call as absorption rate, here it's called as a cost driver rate. There, what was called as a departmental overhead, here we call it as a cost pool. That is the particular activity's cost amount. Are you clear with this? These are some basic differences, but for that, everything else is the same, and this is going to be a very structured and an easy chapter of all. Are you clear with this, guys? Every attempt they are testing for about 10 marks. ABC and overheads put together, short 10 marks. At times I've even seen 15-20 marks coming to these two chapters put together. So this is going to be a huge coverage, right? This is all about it. Sir, that's all, sir. Why is it why people say it's difficult? After finishing overheads, now if you see this, it is going to be easy because the base for this chapter is actually overheads. The flaws of overheads chapter are getting fixed under this particular chapter. Clear with this, guys? So now let's move on. Let's move on directly to a numerical problem. Look at this illustration. KD Limited is following an ABC costing system. The budget overheads, the cost drivers, and the volumes are as follows. Now look at this. Instead of departments, they have mentioned the activities, right? Material procurement activity, your material handling activity, your maintenance activity, setup activity, quality control, right? They have listed the activities. Each of the activity, how much is the cost incurred? That amount is called as cost pool. Learn the terminologies, right? The cost pool is given. Now they've also given the cost driver. What do you mean by a cost driver? The factor that drives that particular activity's cost. This is nothing but the base quantity. So material procurement activity is driven by what? Number of orders. Clear with this? Material handling driven by the number of movement. Maintenance hours. Setup, number of setups. Quality control, number of inspection. Clear with this? Now they have also given the cost driver quantity. This is nothing but the base quantity. The values are given. Totally in this particular year, 1200 orders were there, 1240 movements were there. So 17550 maintenance hours, 1450 setups, and 1820 inspections were there. Clear with this, guys? These are all given. The company has produced a batch of 7600 units. Its material cost was 24,62,000 and wages were 4,68,500. Right? The prime cost components are given. Usage activities of the said batch are as follows. So now this is all these cost drivers are for a year. Now what have they said here? One particular batch, they have given the data. So material orders were 56, 84 material movements were done, 1420 maintenance hours, 60 setups, and 18 inspections. You are required to calculate the cost driver rates and calculate the total and the unit cost of the particular batch. Now guys, very simple. Now it's a 3-step procedure, rather I would say a 2-step procedure in ABC. First, you need to calculate the cost driver rate. This is similar to what? Absorption rate. Now what will you do here? List out the activities, right? Now what is going to be your total activity wise cost pool? You take that divided by the total cost drivers for the year. You take it. Now you will arrive at the cost driver rate. Cost driver rate will be what? In this case, for every order, the material procurement cost is 1535. Material handling activity, per movement, the cost is so much. Maintenance, per maintenance hour, it is so much. Per setup, the setup cost is so much. Per inspection, the quality control cost is so much. Like this, you will arrive at the respective cost driver rates. Are you clear with this? Now what will you do? So they have given us that, look at this, for a particular batch, the batch size is how much? For a particular batch with a batch size of 7600 units, they have given the material cost and the wages cost. So now look at this, the material and the wages cost are given. And I think the batch size is 7600. Okay, 7600 units of a particular batch. So now material labor, this is given. Overheads, how will you calculate? This batch has consumed 56 orders, 84 movements, 1420 maintenance hours, 60 setup hours, and 18 inspections. So what you need to do is take the respective cost driver quantity consumed and multiply it with the respective cost driver rate we just found out here. You marry the figures. That's about it. That is nothing but absorption rate into base quantity consumed. Here you call it as cost driver rate into cost driver quantity consumed. You just do it. So now what you will get is, you will get the product wise total for this batch. What is the total cost divided by the number of units? You will be arriving at the total cost per unit. Are you clear with this, guys? Anyways, this is the objective of this chapter also. Are you clear with this? The only difference is what? Instead of using departments as the base, here we used what? Activities as the base. Are you clear with this? Now there are a few lines of differences between your traditional overhead costing system, I'm calling it as TCS, traditional costing system, and ABC. There under the traditional costing system, what was called as departments, here it's called as activities. There what was called as departmental overheads, here is called as activity cost pool. Then what was called as absorption rate is here called as cost driver rate, and what was called there as base quantity here is called as cost driver quantity. This is all the difference between your traditional costing system overheads chapter and ABC, but for that everything else is the same, guys. Are you clear with this, guys? Are you clear with this? But it's equally important. It's equally important, no doubt. It's important because generally ABC sums will be big, solution will be simple. Why is it big? Because they need to necessarily give you a lot of data. Clear with this, guys? Done, right? Now let's do one numerical problem here. That's about the chapter actually. That's about the chapter. Now let's do a numerical problem here. ABC Limited manufactures two types of machinery, equipment Y and equipment Z, and applies or absorbs the overheads on the basis of direct labor hour. Presently, they are using the traditional costing system. They are taking the direct labor hour as the base quantity. The budgeted overheads and the direct labor hours for the month of December are 12,42,500 and 20,000 hours respectively, right? So with this, you can calculate the predetermined rate. This is as per the traditional system. The information about the company's products is given as follows. So equipment Y and equipment Z, the budgeted volume is given, the number of units of Y and Z produced, the direct material cost is given per unit, right? The direct labor costs. So every unit of Y takes 3 hours to complete, and every hour of Y is going to take what? And every hour is being paid at the rate of 150. So it's going to be 450 rupees. And every hour, every unit of Z takes 4 hours. And every hour is paid at an hourly rate of 150. So 4 into 150, 600 rupees is the labor cost per unit of Z. Now, ABC's limited overhead of 12,42,500. What is this figure? The total overheads that we had. Now they are breaking it. It has been identified with three major activities. Order processing 2,10,000, machine processing 8,75,000, product inspection 157,500. Now they have broken it down into multiple activities. These activities are driven by the number of orders processed. That is, your orders processing is going to be driven by the number of orders processed, your machine processing based on your machine hours, and your product inspection on the basis of inspection hours. The data are given below. Total number of orders processed 600. Out of that, 350 were the orders processed for Y and 250 were the orders processed for Z. Similarly, machine hours work total is given and product wise breakup is also given. Inspection hours total is given, product wise breakup is also given. Right now, required number 1, assuming the use of direct labor hours to absorb or apply the overheads to production. Compute the unit manufacturing cost of equipment Y and Z if the budgeted manufacturing volume is attained. Now, using the traditional costing system, you calculate the absorption rate and all, charge it to the product and arrive at the total cost of the product. This is what they have asked for. Now, that's pretty much simple. We know that the direct material cost is given, direct labor cost is given. Now, how do you arrive at the overhead rate? Very simple. So, in the traditional system, it's going to be budgeted overheads divided by budgeted hours. 12,42,500 divided by 20,000 hours. So, how much is that going to be? That is going to be 62.125 rupees per hour. This is the absorption rate. Correct, guys? Right? Now, we know that, yes, product Y, that is equipment Y, took 3 hours and equipment Z took 4 hours, right? So we just need to multiply it here. So equipment Y took 3 hours. So it's going to be 3 into 62.125, and equipment Z took 4 hours, 4 into 62.125. So product wise, what is the overhead cost? 3 into 62.125, that gives you 186.38 rounded off. And similarly here it's 4 into 62.125, that gives you how much? Roughly, I think they have retained the decimals here. It comes out to 248.5. Now it's pretty much simple. What they have done, they have taken an absorption rate, maybe in this case even a blanket rate they have taken, and charge it off the products. Are you clear with this, guys? So with this, you've got what? The equipment Y and equipment Z's total cost, you have arrived at it. Clear with this, guys? Clear with this, guys? Now this is based on what? This is based on your traditional costing system. Next, suppose now they are using this ABC system. Now what will happen here under the ABC system? Look at this. Under the ABC system, the total overheads is now broken up into 3 different activities. So now we have the activity cost pool, and the activity wise we know what is the total activity cost driver consumed. So you divide the two, you can arrive at the cost driver rate. So now I told you guys that the activity based costing system, that's a 2-step approach that we need to follow here. So first you break it down into activity. This overhead cost ideally is called as cost pool. So now I have the activity wise how much is the cost, right? And what is the activity wise cost driver quantity? 600, 50,000, 15,000. I have this here. These are given in the questions, 600, 50,000 and 15,000. So whatever is the cost driver that drives the respective cost, that drives the respective activity that I need to take, and I have arrived at the cost driver rate here. So it's going to be 350 rupees per order processed. This is going to be 17.5 per machine process. And here it's going to be 10.5 rupees per inspection hour. Are you clear with this? So now that I've got the cost driver rate, what will I do now? Now under the ABC system, anyways, my direct material, direct labor, the prime cost components and all will not change whether I follow traditional costing or my ABC, because the traditional costing, overhead costing and your ABC deals only with the overhead component. They don't deal with the prime cost component. Now in this case, what happens here is, so now first you have the 3 products here. You have the 3 activities: order processing, machine processing and inspection here. Now look at this. So now what do you do here? First, you just have to marry the figures. With respect to order processing, the cost driver rate is how much? 350 rupees. 350 rupees. Now, I have 350 orders for Y and 250 orders for Z. So here it's going to be, right, 350 orders into 350 rupees. That gives you how much? 1,22,500. 250 orders into 350 rupees, that gives me 87,500. That is the cost driver rate multiplied with the cost driver quantity consumed for the respective product. If I do, automatically I will be getting what? I will be getting my respective share of the overheads for the respective products. Similarly, machine processing activity, if you see, what is the cost driver rate? 17.5 rupees. So I have the 17.5 rupees here. Multiply it with the respective machine hours taken by the products. Each of the products took how much? 23,000 and 27,000 respectively. So you just need to multiply it here. So 23,000 and 27,000. So this is going to be 23,000 hours into 17.5. This is going to be 27,000 hours into 17.5. Are you clear with this? This is going to be the respective calculation. Are you clear with this, guys? Are you all clear with this? Similarly, for inspection, per inspection hour, it's going to be 10.5. And how many inspection hours were spent for the respective products? 4,000 and 11,000 respectively. So it's going to be 10.5 rupees into 4,000, 10.5 rupees into 11,000. I'll get these figures. So now we've got what? The overhead cost for each of these 2 products as well. So now what do we do? Divided by respectively by the number of units, you will get the total cost on a per unit level. As simple as that. Guys, this is not a very intricate or a difficult calculation and all. Basically everything is the same. Instead of calling it as an absorption rate, I call it as a cost driver rate. Instead of calling it as a base quantity, I call it as a cost driver quantity, and I just charge it off to my products. Are you all clear with this, guys? Don't think that this is something else. This is very simple. The issue only is here you need to understand why we are doing ABC. Once you know that, it is going to be a cakewalk, and as simple as that. Clear with this? Done, guys? Are you all done? Are you all able to understand this? Right? What is the next part of the question? ABC Limited's selling price are heavily based on costs. By using the direct labor hours as an application base, calculate the amount of cost distortion that is under or over costed for each of the equipment. Now, what they are saying. Now, look at this. If I follow the traditional costing system, what is the cost per unit? For Y, it is 936.38. For Z, it is 1298.5. Whereas if I follow the correct ABC system, the per unit cost is changing, correct? So now what we need to do is look at this. If I am following the traditional costing system, this will be the respective cost per unit. If I am following the ABC system, this will be the respective cost per unit. Ideally speaking, which is correct? ABC is correct, but currently the company is following what? Direct labor hour as the basis of apportioning your indirect cost. So now ideally every unit should have been costed at 976.8, but they are wrongly costing it at just 936.38. What has happened? The cost distortion is the product Y is being undercosted to the extent of 40.42 rupees. Are you clear with this? Similarly, for equipment Z, presently they are valuing it, or they are costing it at 1298.5, but ideally speaking, it should have been valued at 1266.16. The difference is what? They are overvaluing it by 32.34. Are you clear with this? Both undervaluing and overvaluing, that is both undercosting as well as overcosting, are bad. You need to use the right methodology of costing. So look at this. The low volume product Y is undercosted and the high volume product Z is overcosted using the direct labor hours for absorption, overhead absorption. See, a wrong methodology of absorbing your overheads will lead to a wrong selling price fixation, which will result in a huge failure of the business itself. Now, honestly, guys, this is the reason why many startups fail. What they do is, the moment they see little amount of money, they spend a lot in a lavish office and all that, without knowing that all these office are overheads. It needs to be properly apportioned. It needs to enter into the product properly and unitized properly. Based on that, the selling price needs to be fixed. They don't even know that the market is ready to pay that much. If they take all these costs and add it onto the product, now what will happen? The market will not be ready to pay, because your price will be more. Your competitors will be fixing a price which is nominal. Right now, no one will come and buy it from you. Your business will crash. This is the reason ABC is actually a game changer in the industry, because for every activity, it is showing you the driver. Right now, if you want to reduce the particular activity cost, you can just go and reduce the cost driver. That's all. Clear with this? So there is a direct relationship between the cost driver and the cost pool. If you want to reduce a particular activity cost, go and control your cost driver. Are you clear with this, guys? Are you clear with this? So for example, right, in your real day life, you can use ABC and all. For example, if you are a student who is attending a face-to-face lecture, right, your cost driver will be number of lectures held, not the number of hours. Because you will say, sir, every day if you keep totally, let us say I'm planning for a 100-hour session. Example, I'm telling you, if I every day keep a 2-hour session, so I will be conducting the class 50 times. Correct? Which means you need to come and go for 50 times. Your cost is driven by the number of visits or the number of lectures. Correct? If you are a face-to-face student, because every time you come and go, you will be incurring transportation costs. Correct? That you only need to bear. Yes, guys. Whereas if you are an online student, you will not be bothered about the number of lectures. You will only be bothered about the hours. Why? Because 100 hours you are watching a lecture, right? Accordingly, you need to be incurring some electricity cost, obviously some basic light, or you'll be using a system for that, some electricity cost that is driven by the duration, not by the number of lectures. Clear with this? So for you, the cost driver, you will be driven by the number of hours, the duration. Whereas a person who is attending a face-to-face, he will not be bothered much about the duration. He will only be bothered about the number of lectures. He will say, sir, this 100 hours, sir, you finish off in 10 days. 10 days per day, 10 hours you take, finish off. He will be happy. Are you clear with this? Are you clear with this, guys? Even in real life, you can use ABC in order to control your costs. Simple. You just list out all the costs that you are incurring, right? Break it down into activities. obviously you will know for this activity, this is the cost driver. You will be able to easily find out based on that. If you want to reduce your overall monthly expense, what you need to do is put an activity based costing budget, right? And then you just try to reduce your activity cost drivers, the factors that drive the cost. Automatically your cost, at least to some extent, can be controlled, or at least you will know where you're spending your money. Clear with this, guys? That is about this particular question. And there's one more question which is quite unique. I just wanted to share this with you as well because it's there in the study material. MST Limited has collected the following data for its 2 activities. It calculates the activity cost driver rates based on the cost driver capacity. Now look at this: power and quality inspections. Power and quality inspections, these are the 2 activities. They are driven by kilowatt hour and number of inspections respectively. So this is not kilowatt hours, this is cost driver quantity. So there are 50,000 kilowatt hours budgeted and 10,000 inspections budgeted, and the cost pool is 2 lakh and 3 lakh respectively. The company makes 3 products, M, S and T. For the year ended 31st of March, the following consumption of cost drivers were reported. Now what they have done, product wise, they have given the total kilowatt hours consumed and the total quality inspections done. Are you clear with this? Now compute the costs allocated to each of the product from each of the activity. Now first, what will you do? You will calculate the cost driver rate. How will you find out the cost driver rate? The respective cost pool divided by the cost driver quantity, the budgeted cost driver quantity. See, the concepts of your absorption costing remains the same. Here also you can work only on your budgeted data, because costing can't wait till the year end. So here also it is budgeted cost pool divided by budgeted cost driver quantity only. Are you clear with this? So here what we will do, we will arrive at the respective cost driver rate, multiply that with the actual cost driver quantity consumed. You will be able to apportion your overheads to the products. Now look at this here. Look at this here. Now you have the respective products M, S and T. Okay, fine. First, the cost driver rate is 2 lakhs divided by 50,000. This is 4 rupees per kilowatt hour. Inspection, quality inspection is 3 lakh divided by 10,000, 30 rupees per inspection. This is nothing but the data that they have given on the top, the first dabba. So 2 lakh divided by 50,000 and 3 lakh divided by 10,000. You arrive at the cost driver rate. What will you do now? Multiply it with the respective cost driver quantities consumed. Clear with this, guys? So now what will we do here? What will we do here? With respect to the power activity, right? So product M consumed 10,000 kilowatt of hours, product S consumed 20,000 and product T consumed 15,000. Multiply it with 4 rupees, because for every kilowatt hour consumed, the charge, overhead charge is going to be 4 rupees. So you will get a share of 40,000, 80,000, 60,000. So at the end of the year, if you see actual overhead charge is how much? It's going to be 1,80,000 rupees. Similarly for QC, the quality control, how much is that going to be? 30 rupees per inspection. Now product wise, they have given us that 3,500 rupees, 3,500 inspections were carried out for product M, 2,500 for S and 3,000 for T. Multiply the respective inspections with the 30 rupee of cost driver rate. You will arrive at the product wise share of quality inspection cost. If you add up, you get the overheads absorbed to the extent of 2,70,000 using the concept of ABC. Clear with this, guys? Clear with this, guys? This is what they've asked in the first part of the question. Number 2, calculate the cost of unused capacity. This is nothing but your under or over absorption using ABC. Now what I had budgeted a cost of 2 lakh rupees for power, but what I had actually absorbed using ABC, I absorbed only 1,80,000. Guys, correct? Yes. So here the difference between the two is going to be what? 20,000 rupees. This is nothing but the unused capacity or unabsorbed overheads. Clear with this? Similarly for the quality inspection, I was planning to incur how much? 3 lakh, but I actually ended up consuming only or absorbing only 2,70,000. So here again there is an unused capacity to the extent of 30,000 rupees. Add the two, the total value of unused capacity is going to be 50,000 rupees. Are you clear with this, guys? Are you clear with this? Right? This chapter is, that's all. It's very simple. It's an extended arm of your overheads chapter. Do not see this as a separate chapter. That's what I would suggest. And this chapter is in fact much more logical and it's much more practical as compared to your overhead chapter. Clear with this, guys? Are you all able to follow this? Any issues here? Any issues here? Right? That is all about this concept of activity based costing, right? And with this, we have also completed this chapter. Remember one thing, there is a two-step process in your ABC, all the sums. The first step is calculating your cost driver rate. The second one is charging your overheads to the respective products. So the terminologies alone are different, but for that, everything else is going to be the same. So that's what I said. Even in this chapter, the objective is to calculate the overhead cost per unit, right? It is same as the previous chapter of overheads. The only difference is the journey that it takes. There we did it based on departments. Here we are doing it based on activities. Are you clear with this, guys? With this, we have completed this particular chapter called as ABC as well. So now let's get started with the revision of the last chapter of this marathon series, which is divisional performance measurement, right? Now, this chapter is broadly bifurcated into 5, right? So these are the 5 concepts that revolves around this entire chapter. First, you have something called as DuPont analysis. It's not DuPont, it is DuPont analysis, right? Then you have something called as DPM tools, that is divisional performance tools, divisional performance measurement tools, which is 2 tools broadly mentioned here: ROI, return on investment, and residual income. Then you have something called as the EVA, which is economic value added. Then you have learning curve, and you have balanced scorecard, right? Now, in this marathon, we will be covering these 3 segments. That is your DuPont analysis, your DPM tools, that is ROI, residual income, and economic value added. The learning curve and balance scorecard. Balance scorecard, anyways, is more of a practical theory in nature, right? And this learning curve, these 2 alone, we will be discussing in depth in our regular lectures. But in our marathon, these 3 we will be covering. Clear with this, guys? Now, before we enter into this chapter, one more thing I want to tell you guys, especially for the ones who have not watched the regular lecture. This chapter predominantly revolves around your financial management. This chapter predominantly revolves around your financial management. Then, sir, why are we studying it here in management accounting? Look, cost accounting, management accounting, financial management, these are all interrelated disciplines, interrelated subjects. So obviously here and there the reference will be coming, and this chapter squarely, predominantly, whatever aspects that we are learning in this chapter are covered under financial management. For example, your return on equity calculation, right? The very basic DuPont analysis itself is actually a financial management concept. Your return on investment, your residual income. So you have something called as financial leverage that comes in here, right? Then you have concepts of weighted average cost of capital. All these things are ideally a part of financial management. So this particular chapter requires some basic knowledge of financial management. Clear with this, guys? Now, what does this chapter talk about in a nutshell? First, as usual, let us learn the basic backdrop of this chapter. Why do we have this particular chapter? First, as the name suggests, what do you mean by divisional performance measurement? Now, let me tell you one thing. First, before we move into the technicalities of this particular chapter, what do you mean by a division? Many students think that a division means in an organization, multiple departments I have is called division. No. Department is one type of division. Department is not the only division that you can have, right? A division could be either a department, a division could be a branch, while a division could even be a subsidiary company. For example, this is the exact example that I took even in our regular batch, right? So this Tata group of companies we have, right? The flagship, the holding company is called as Tata Sons Limited, right? This Tata Sons Limited, right, is actually an investment company. It invests in multiple companies, right? And these companies in which it has invested is only this TCS, your Tata Consultancy Services, which is into software, the IT sector. You have this Tata Elixir, Tata Motors, Tata Finance, Tata Powers, many companies. Are you clear with this? Now, the managing director of the flagship of the holding company, Tata Sons Limited, now he needs to know whether each of the company's divisions are performing well or not. Correct, guys? Right? Now, when I say divisions here, in this case, it's clearly a subsidiary company itself. Now this Tata's TCS, let's just take one small baby of Tata Sons, TCS. I'm just saying it's a baby, but in terms of business, TCS itself is huge. It's one of the unicorn startups in India. Unicorn startup means what? It reached a valuation of $1 billion. 1 billion means it's 100 crores. 100 crore dollar is the valuation. I'm not talking about the turnover. It's the valuation. Clear with this, guys, right? It's about 8,000 crores or whatever it is. Are you clear with this, right? So now such massive businesses. Now just imagine you are the managing director of the flagship Tata Sons. You have many subsidiary companies under your ambit. Now, how can you track the performance of each of your divisions? Are you clear with this? Now, using certain tools which we are going to discuss in this chapter. This is the context. First, whatever you learn it conceptually and learn the background. Spend a little time automatically. Whatever you learn, it is going to be a best learning experience for you so that you need not mug up, right? Now, so there are certain tools like your DuPont analysis, your return on investment, residual income, EVA. These are predominantly the tools involved in divisional performance measurement. Additionally, you have two more concepts like learning curve and balance scorecard. Clear with this, guys? Right. Now, this is the reason why we are studying this chapter, using certain techniques, how you can track the performance of your divisions. Now, one more thing, sir, is it useful only in case I have multiple divisions? No, even for standalone companies, right? Say, take one small company in which you are doing an audit. Right, one small company, even the standalone company also, you can use these tools to assess how this company is performing, compare it with the industry standards and see how it is working and all. So here we are more specifically using it for evaluating our divisional performance. Are you clear with this, guys? Now, before we get into this chapter, there is one very important background that you need to know, which I call it as income statement. By the way, guys, all these things are not there in your institute study material, but without knowing this, you can't even enter into this chapter. That's why this background is very important. Now, how does your income statement look like? Sales minus variable cost gives you contribution, minus fixed cost gives you operating profit. It's also known as EBIT. From your EBIT means what? Earnings before interest and tax. First, you reduce interest, you get EBT. From that, you reduce your tax, you get EAT. From that, you reduce your preference dividend. You have what you call it as net income, or this is also known as earnings available for equity shareholders, which I call it as EFE. Clear with this? Now, up to this EBIT level, right? Up to this EBIT level, right? This is the scope of coverage in your cost accounting and management accounting. Are you clear with this? And from EBIT level, it is getting covered under your financial management. That's why I generally say financial management starts from where your costing ends. When I say costing, I mean cost and management accounting put together. Clear with this, guys? Right? Now, this is one format that you need to know forever. Clear with this? This is an interlinking which will be helpful for you to understand this particular concept, this particular chapter. Now, first, DuPont analysis. What does this DuPont analysis talk about, right? An in-depth discussion we have seen in our regular lecture, but here, again, I'm giving you a capsule and an overall executive summary. Now, what is this DuPont analysis? First of all, sir, why this name? This analysis was found by a US-based company called as DuPont Corporation, and hence the name DuPont analysis. That's all. It's basically the name of a company which founded this particular method. Now, what does this say? Simple, guys. It talks about return on equity. Return on equity. What is the formula? What is the formula? Now, guys, if you look at the statement, right, you have EBIT minus interest, EBT minus tax, EAT. You further reduce preference dividend. Whatever amount left over is called as net income. This belongs to whom? The equity shareholders, right? Now, the return on equity, if you are calculating, how will you calculate the amount available to the equity shareholders divided by the amount invested by the equity shareholders? Correct? You are looking at it from the perspective of equity shareholders, right? So my return, what I receive divided by what I have invested from a viewpoint of equity shareholders. So what I receive as in what belongs to me, the net income or the earnings available for equity shareholders divided by the total equity. When I say the total equity, it means the equity share capital reserves and surplus, everything put together. Clear with this, guys? This is the return on equity formula. Fine, sir. Return on equity formula is this, we all know. Now, what does this DuPont analysis say? DuPont analysis is actually bifurcating this return on equity formula into three. It says return on equity is equal to net profit ratio into asset turnover ratio into financial leverage. This financial leverage is also known as equity multiplier. What it is, I will tell you. Now, sir, how does this work out, sir? Net profit ratio, what is the formula? Net income divided by sales, correct? Net income divided by sales, yes. Asset turnover ratio, what is the formula? Sales divided by total assets. Then financial leverage, the formula is total assets divided by total equity. Now, what happens if you multiply the two? Sales and sales will get cancelled. Total assets will get cancelled. As an end result, you will be left off with net income in the numerator, equity in the denominator. Fine, this is what you get here. Are you clear with this? Sir, what is this, sir? Cheating. You have just multiplied three figures, used mathematics and called this as an invention, and you are also putting it a name called as DuPont analysis. No, it's not like that. This is a beautiful analysis which has been made by this DuPont Incorporation. What it is, I will tell you. Now, mathematically, this is how it looks like, but actually, this gives you a wealth of information regarding the performance of a company. How, I will explain in a nutshell. Now, net profit ratio, right? Net profit ratio, what does it indicate? It indicates the profitability of a company. For example, so what is this? Net income upon sales. Let us say the company is earning a net income of 20 rupees for every sale made of 100 rupees. So now what will I say? The net profit of the company is what? 20%. Are you clear with this? Similarly, your asset turnover ratio. What is asset turnover ratio? It judges the efficiency of a company. Sir, how are you saying this, sir? Now, let me just take a random standalone example. Let us say the company has invested 100 crores in its assets, right? So, 100 crore will come in the denominator, and the sales of the company is, let us say, 500 crores. Are you clear with this? So now the asset turnover ratio is going to be 5 times. Sir, what is the meaning of this? For every 100 crore invested in the business, the company is able to, they have used this asset and they have generated 500 crore rupees worth of sale, or in other words, their asset turnover ratio is 5 times. So higher the asset turnover ratio, higher is the efficiency. So now if the company is able to generate more sales using this asset, it shows how efficient the company is. Are you clear with this, guys? This is what it is. Now, this third segment called as financial leverage, right? What is it? The total assets divided by equity, right? This shows the leverage effect. What do you mean by leverage effect? Again, a very, very technical aspect in financial management, which we generally discuss in our financial management lectures. But anyways, here for the limited purpose, let me again give you an example. Let us say there are two companies, right? Company A, company B. Both the company has raised a total capital of 100 crore. There is only one difference. What is it? Company A raised 50 rupees from equity, 50 rupees from debt. Clear with this? Now, if I were to compute this leverage for company A, so it is going to be total assets divided by equity. How much is total assets? 100 crore. How much is equity? 50 crore. So here the leverage is 2 times. Correct, guys? Now, company B, it has also raised the same amount of 100 crores, but what they have done, instead of 50-50, they have raised more amount from debt and less amount from equity. Here, it is 20 only from equity, but 80 rupees from debt. For this company, you compute the same leverage formula, you put total assets divided by equity, 100 divided by 20. Here, this company's leverage is 5 times. Sir, what does this say about the company, sir? Wait. Now, what happens here is, just erasing this off. Now, what happens here is, this is where DuPont analysis becomes really, really helpful for us. Now, what happens here is, now, we just saw that the return on equity is nothing but the multiplication of your net profit ratio, your asset turnover ratio, and your financial leverage. Are you clear with this? Now what happens in this case? For company A, what happens? The profitability, efficiency will be the same, but here with respect to financial leverage, what I will do, I will multiply it with 2 times. Whereas if it is company B, here I will multiply it with 5 times. Are you clear with this, sir? What is the difference? Now you tell me, company B has not done anything, productive, or it has not done anything organic to achieve this higher return on equity. what they have done, they have just managed something with a source of funding. Because of this, there is a magnifying effect which would result in a higher return on equity. Now, as compared, let us say company A, company B, they have the same profitability, same efficiency, but because of leverage effect, company B will be reporting what? Company B will be reporting a higher return on equity. Are you clear with this? Now, is it really because of the efforts of company B? No. They just manage something with the source of finance. This is called the leverage effect. Because of that, it magnifies its return on equity. So, sir, so leverage is good, no, sir? So higher the leverage, better it is? No. No, it's not like that. Leverage, as we call it, is a double-edged sword. Sir, it's got magnifying effect, no, sir? Wait, let us just imagine this company is making, the profitability is, let us say instead of 20%, it is minus 20%. Now what will happen? This negative figure will also be multiplied with 5 times. Now higher this, in this case, it will also amplify its losses. Are you clear with this? So leverage has an amplifying effect. It has what? That magnifying effect is there, but it will magnify. If there is a profit, it will magnify your profit. If there is a loss, it will also magnify the loss. Hence, leverage is considered to be risky. Right? Leverage is generally an indication of financial risk. Right? This is what is getting covered under financial management. Now, basically, sir, why do you need all these things? Now, what I would do is company A, company B, right? Two companies have reported return on equity. Company A, let us say, has 10% return on equity overall, the final figure. Company B has 15% return on equity. Now, don't blindly say company B gives a higher return on equity, go for company B. No. Split it into 3, that is your net profit ratio, your profitability, efficiency, and leverage effect, and see the reason why both the companies are reporting what? Reporting the respective return on equity. If you find that company B has a higher return on equity purely because of its leverage effect, then never go for that company, because today it's reporting a profit, the profit is getting magnified. Tomorrow, if there is a loss, your loss will get magnified and your entire money will get lost. Hence, it is not enough if you just know the return on equity. You should know the components of return on equity. Based on this, you need to arrive at a judgment. Are you clear with this? Now, let us do one numerical problem in this regard. This will clearly tell us what this particular concept is trying to convey. Clear with this, guys? Now, let's get started. This is question number 1. Now, what have they mentioned? An investor is interested to invest in any one of the two similar companies within the same industry. The investor wants to use a DuPont analysis method to compare the company's strength in areas of opportunity and help him decide which company is better. Fine. What have they mentioned here? The following are the information about the companies. Net income is given, revenue, average assets, average equity, right? So now, guys, what do you have here? Let's calculate the return on equity directly. Return on equity for company A, how much is the return on equity? The return on equity is going to be, right, 2000 divided by 2000. The net income divided by the equity, right? It's going to be 100%, correct? Or I will call it as 1. That is, for every 1 rupee I invested, I will get a return of 1 rupee. This is the meaning of that. For company B, how much is it? 2500 divided by what? 1000. So it's going to be 250%, or I will say 2.5 rupees. Or in other words, for every 1 rupee invested in company B, I will be getting what? 2.5 rupees. Are you clear with this? Now, purely looking by return on equity, which company has a higher return on equity? Company B. So you will say that, sir, it is better to go for company B. Correct? Now, wait, do not jump to that conclusion. Now, what we will do is, for each of the two company, let us calculate the breakup of this particular return on equity, that is the profitability, efficiency, and leverage effect, right? So that is what we have done here. So now in this company, first, what is the profitability of these two companies? With respect to profitability, right, if you look at this, it is net income divided by sales. For company A, it's going to be 2000 divided by 8000, right? So 0.25, 25% is the profitability for company A. For company B, what is the profitability? 2500 upon 20,000, it's going to be how much? 12.5%. Are you clear with this? Next, the next one is going to be the asset turnover ratio. What's the asset turnover ratio here? It's going to be the revenue sales divided by average assets. So 8,000 divided by 5,000. So company A, the efficiency is 1.6 times. Company B, 20,000 divided by 8,000, it's going to be 2.5 times. Are you clear with this? Then how about your magnifying effect, that is your leverage effect, equity multiplier? So here you have total assets upon equity. It's going to be what? 5,000 upon 2,000. Here it's going to be 8,000 upon 1,000. So here it's going to be 2.5 for company A and it's going to be 8 for company B. Are you clear with this? So now basically what we do is, so for company A, how do you arrive at this return on equity? What is the total return on equity? 1 or 100%. How do you get this? It is 0.25 into 1.6 into 2.5. Correct? Here it is 0.25 into 1.6 into 2.5. Correct? So what does this 0.25 indicate? This indicates the profitability of the company. What does this 1.6 indicate? It indicates the efficiency of the company. And what does this 2.5 indicate? It indicates the leverage effect of the company. Now look at company B. This is how you multiply this. So 0.25 into 1.6 into 2.5, you get exactly 100%. This is the breakup of return on equity. Correct, guys? Next, here you look at this. Here for company B, what do you get? 1.125 into 2.5 into 8. So 0.125 into 2.5 into 8, you get how much? 2.5, or in other words, in terms of percentage, it's going to be 250%. Are you clear with this? Right? Now you look at this. On the face value, company B reports a high return on equity, right? But look at this. Why is company B reporting a high return on equity? Predominantly, it is because of the leverage effect, right? 8 times is the leverage effect. Because of the leverage effect, overall the return on equity appears to be high. This is just a temporary feature, right? But look at the profitability. Company A has a net profit ratio of 25%, which means what? For every 100 rupees of sale made, they are earning organically from their operations, they are earning 25%. Whereas company B is only earning half of it. It's only earning 12.5, right? So the profitability is not up to the mark for company B. Efficiency, okay, efficiency decent as compared to company A. The efficiency for company B is decent, but our profitability is not that great. Still, why is company B having an excellent return on equity? It is all because of what? It is all because of your magnifying effect, leverage effect. Now, suppose the company is actually getting into a decline phase. What happens? The losses will also get magnified with 8 times. You will lose all your money in this company. So this high return on equity is just a temporary feature right now reported by company B, because it is predominantly dependent on the leverage effect for reporting its return on equity. Clear with this? So now any day I would prefer company A than company B. Why? Because I would say that company A is organically growing as compared to company B. Look at this. It's got 25% of profitability, 1.6 times efficiency, and some decent leverage. They are also making use of leverage effect. Clear with this? But they are not dependent completely on the leverage for the purpose of reporting their what? Return on equity. Clear with this, guys? This is why DuPont analysis is very important. DuPont, if you do not use DuPont analysis, you would have gone for company B. Whereas DuPont analysis now clearly gives a breakup of how you have arrived at the return on equity, and it says if a company is heavily dependent on their leverage, do not go for that company. It's a caution. Are you clear with this? This is what they have given. All these are study material questions. CMA Institute study material question. The DuPont analysis model allows the investor to see that although company B has higher return on equity ratio than company A, a large portion of company B's return on equity results from its equity multiplier. Just now I told you the leverage effect. The investor can also see that a large portion of company A's return on equity results from its 25% net profit margin. So here company A is dependent on its organic growth, which is nothing but the net profit margin, whereas company B is heavily reliant on their equity multiplier. So now any day company A is better. Look at this. Because of this information, the investor invests with company A. Are you clear with this, guys? Are you clear with this? This is the beauty of DuPont analysis. Clear with this, guys? So that's about this concept of DuPont analysis. And with that, we're done with. There's only one question given here with respect to DuPont analysis. The next one is a concept called as residual income. What do you mean by residual income? This is the formula given. Residual income means operating income. Operating income is nothing but EBIT. Correct? We just saw here in the statement, operating income, your operating profit is nothing but EBIT, right? Your costing profit, right? Operating income minus the minimum rate of return into operating assets. Or in other words, what they are trying to say is residual income means the income earned in excess of the minimum income required to be earned. What is the minimum income required to be earned? Total assets invested in the company. Multiply that with the minimum required rate of return. Let us say the company has invested 100 crores into the business. The minimum required rate of return is 12%, right? So now what happens? 12% into 100 crores. So definitely the company wants to earn how much? The minimum required return in terms of amount is 12 crore. But the operating profit is, let us say, 15 crores. So the company has earned 15 crores. The minimum required return that the company wanted to earn was only 12 crore. This extra amount of 3 crore is called as what? Residual income. The extra income that I've got. The extra income that I've got. Clear with this, guys? Now, this minimum rate, sir. So how will I know what is the minimum rate? That minimum rate. What is the minimum required rate of return? That is nothing but your minimum cost. You should at least earn the amount that you spend. What is the minimum cost, sir? So what is the cost that I spend? It's nothing but weighted average cost of capital. Are you clear with this? Weighted average cost of capital. So what do you mean by weighted average cost of capital? Quickly, I'll just give you one quick run through here. Let us say a company has raised 100 crore rupees, right? 20 crore rupees it has raised from equity, 80 crore rupees from debt, right? Now 20 crore rupees of equity component, right? It is raising it at a cost of 18%, okay, and debt of 80 crore rupees, it is raising it at a cost of 12%. Are you clear with this? This 18%, as you all know, it's called as cost of equity, or KE, popularly known as KE. This 12% is popularly known as cost of debt, KD. Clear with this? So, sir, for 20 crores, the cost is 18%. For 80 crores, the cost is how much? 12%. Now, I don't want all this breakup, sir. Overall, how much the company has raised? 100 crores. For 100 crores, what is the cost? You tell me. How will you do it? Simple. 18% into 20. This is the cost I incur on equity. Plus 12% into 80. Right? This is the cost I incur on debt. This is the total cost that I incur divided by the total amount I raise. 100. Are you clear with this? Right? Or in other words, if I want, I can split and write 18% into 20 by 100 plus 12% into 18 by 100. This way also you can write. Are you clear with this? So if you do this, finally you will arrive at a figure of 13.2%. Or in other words, I will say, look, for 20 crores, my cost was 18%. For 80 crores, my cost was how much? 12%. For overall 100 crores, if I weighted average, I'm saying overall for 100 crores, my effective cost is how much? 13.2%. This is called as weighted average cost of capital. This they give it in a formula and all, very simple. There's nothing but KEWE plus KDWD and all is equal to your KO. KO is nothing but your weighted average cost of capital. This is exactly what we did. So this is KE. This is weight of equity, 20 upon 100. Similarly, this is KD, cost of debt. 80 by 100 is the weight of debt. Clear with this? You multiply everything, you get this weighted average cost of capital. That weighted average cost of capital is the minimum required rate of return. Are you clear with this, guys? Right? Now, let's quickly do one sum regarding this calculation of residual income. I think it's the next question itself. Yes, calculation of residual income. Now, look at this. Sales was 4,80,000. The cost of goods sold is 2,22,000. So you get a gross margin of 2,58,000. Selling and admin overheads or expense is going to be 2,10,000. The operating income, also known as what? EBIT, if the company is 48,000. Now, what have they given? Jan 1st, the net book value of operating assets is 2,77,000. And December 31st, the net book value of operating assets is 3,27,000. So you have opening value of assets, you have closing value of assets. So now I need to take operating assets and multiply that with the minimum required rate of return of 12%, correct? So which asset should I take? Opening value or closing value? If both the values are given, take a simple average of that. 2,77,000 plus 3,23,000 divided by 2. How much is that? 3 lakh rupees. Are you clear with this? So what is my residual income? First, the net invested assets in the company is how much? 3 lakh. 3 lakh into 12 percentage. How much is that? 3 lakh into 12 percentage is going to be 36,000, right? 36,000 was my required return in terms of amount. But how much have I actually earned? I have earned 48,000. So I have earned 48,000, but my minimum required return in terms of amount was only 12 percentage on 3 lakh, which is 36,000. So how much extra have I earned? 12,000 rupees. This 12,000 rupees is called as residual income. Are you clear with this? This is all they have given here, guys. Logically learn it. Do not mug up anything. These are all pure concepts that you can learn easily. Clear with this, guys? So higher the residual income, better it is. So now what will I do? So now when Tata Sons is comparing, it will say that, okay, so companies which are having a higher residual income are performing better, right? Because they are exceeding the expectations, exceeding the base minimum required rate of return. So these companies are performing better. This kind of assessment can be done. Are you clear with this, guys? Right? So that's about the concept of what? That's about the concept of residual income. Now let's quickly move on to the next concept, which is return on investment. Return on investment. So what do you mean by return on investment? As you know the word return on investment, the return divided by investment. That is what I get upon what I give. That is what I invest. Here it's nothing but the operating profit. That is nothing but EBIT, right? EBIT divided by what? My capital employed, or in other words, you call it as the net assets, right? Capital employed or net assets. What I earn upon what I invest. This is called as return on investment. Return on investment is another metric which we use to compare whether a particular division is performing better or not. Right now, let's quickly do one numerical problem with respect to this. So I'll just take this question number 11, I guess. Yes. Now look at this question. Okay. Yep. A company had the best year ever with a sales of 45 lakhs and operating profit of 9 lakh 50,000. Right? So what was the sale? 45 lakh. Operating profit 9 lakh 50,000. The balance sheet at the beginning of the year showed the assets used in production with a cost of 2 crore. Opening balance sheet showed that the total assets was 2 crores. Accumulated depreciation was 50 lakhs, right? The company didn't buy any assets during the year, but did have the depreciation expense of 10 lakh for the year. Calculate the return on investment for the year, right? So what they have given also is calculate the ROI by dividing the operating profit with the average book value of the assets. Average book value is nothing but opening plus closing by 2. Now first, what is the opening value of assets? Opening value of assets. So guys, this is simple accounting, right? Opening value of assets is how much? 2 crores minus 50,000, correct? Opening value of assets is how much? Net assets invested in the company is how much? 1.5 crores, correct? Now, there is no addition or deletion, but only this depreciation expense was there. So now what would have happened at the end of the year? Cost remains to be 2 crores, but depreciation would have been how much? 50 lakh plus this 10 lakh. That is 10 lakh is the depreciation charge for the year. So 60 lakh should be reduced now. 2 crores minus 60 lakh. How much is this? 1.4 crores. Are you clear with this? So the opening value of assets was 1.5 crores. Closing value of assets is 1.4 crores. So 1.5 crores plus 1.4 crores divided by 2. So the average book value of assets is going to be 1 crore 45 lakhs. Are you clear with this? This is the asset invested, net assets invested in the company. Now what's the operating profit, guys? What's going to be the operating profit here? They have given it as 9 lakh 50,000. Very simple. So what's going to be your return on investment? So what you get, that is EBIT or operating profit divided by average book value of the assets, 9 lakh 50,000 divided by 145 lakhs. You get how much? A return on investment of 6.55. As simple as that. Clear with this? These are some basic things. In fact, this is actually class 12 question, numerical problem. Right? So with little bit of accounting knowledge, you can directly in your accounts, you would have studied all these things, or in your foundation basics. These are very basics. The same thing is only here. Are you clear with this, guys? So with this, we have covered this particular aspect as well. Now Now let's move on to the final aspect of the final concept that we are going to cover here, which is economic value added, right? So let's get started. Now, economic value added. Now, what is this and how is it computed? Economic value added is equal to NOPAT minus of weighted average cost of capital into capital employed. Sir, what is this? NOPAT means what? Net operating profit after tax, or in other words, operating profit is what? EBIT, right? Into 1 minus T. The after tax operating profit is called as net operating profit. Clear with this, guys? Sir, what are we trying to calculate here? If I were to put this on a statement approach, this is how it will look like. So now, in our statement, that is basically our income statement, I told you, EBIT, right, minus interest gives you EBT, minus tax gives you EAT, right? Now, from this, let us also reduce the cost of equity. What is the cost of equity? The basic return expected by the equity shareholders. Whatever you have in excess is called as the economic value added. Are you clear with this? Sir, why should I do this? Anyways, in this case, whatever is left after paying all the other stakeholders, like your debenture holders and preference shareholders, everything, that entire amount is actually belonging to equity shareholder. Or in other words, in this case, both this cost of equity as well as this economic value added, both actually belongs to equity shareholders. This whatever is left out, who will take this money? This amount goes to only the equity shareholders, correct? It goes to them only. But we are here finding out how much extra they are getting. Are you clear with this? Beyond that expectation, how much extra is the company paying? Clear with this, guys? So now, if you look at this from the EBIT, what are the figures that are getting reduced? Interest, tax, and cost of equity. Now, guys, you tell me, this interest is paid to whom? Paid to the debt holders, debenture holders, right? Why are we paying them? Because we have raised one component of money from them, correct or not? Similarly, the cost of equity is basically what? The basic expectation of return from the equity shareholders. Who are they? They are also one providers of finance, right? We have raised money from them, hence we are paying them. Now you tell me, guys, tax. Is tax a finance cost? Is tax a finance cost? Technically speaking, no. Tax is one different animal altogether. It is neither an operating cost nor a finance cost. Why? Why are you paying taxes? Is it because you have taken some money? The government has invested some money in your company? No. It, as a citizen of this company, or as, if you are doing business in India, right, based on all this residential status and all of that, or source by source, whatever it is, you need to pay tax into the government. As simple as that. If you earn profit, you pay tax to the government. Technically speaking, this tax is an expense paid not to the stakeholders or not to the investor of the company, correct? It is an expense actually that is paid to an outsider. Are you clear with this? So what we do is, so here first, from the EBIT, you reduce this tax and tell me how much extra amount you have. EBIT into 1 minus T. Are you clear with this? This is the excess money that I have. To whom? To all the providers of finance. Are you clear with this? So technically speaking, this NOPAT is the money, net amount after paying the tax that I have, that is available to all the sources of finance. From that, you reduce the cost of all the sources of finance, that is weighted average cost of capital into what? Capital employed. Basically, this will cover what? Your cost of debt, cost of equity, if there is preference, cost of preference, everything. So now clearly, this is the amount you have to all the sources of finance minus the cost that is incurred with all the sources of finance. So how much extra amount you have? That is called as economic value added. You can directly use this formula, right, which I just explained with the help of this statement, as simple as that. Or in other words, how much extra money the company has made over and above paying all the sources of finance is called as economic value added. This is the concept, guys. If you learn it like this, why will you forget? Are you clear with this? Now let's quickly finish off one numerical problem here. So this question number 12. A person made a capital investment of 2 lakh rupees in a company. The operating profit after the taxes is 28,000. The opportunity costs of that investment is 10%. Calculate the economic value added. The opportunity cost in this case is the cost of capital. Very simple. So the NOPAT, net operating profit, EVA, is net operating profit after taxes minus cost of capital, right? What's my net operating profit after taxes? They have given the figure 28,000 minus what is the overall cost incurred for all the sources of finance. So it's going to be 10% on 2 lakh. It's going to be 20,000. So now the amount of cost incurred for fundraising activities 20,000, but I have generated 28,000 with me. This extra 8,000 is called as what? This extra 8,000 is called as economic value added. Are you clear with this, guys? As simple as that. So now it's not just about mugging up the formulas and doing it. Never works. It never works. Please learn it conceptually. That is one very important thing that you need to know, right? Clear with this? So that's why I keep telling you, right, in this revision lecture, whatever extent possible, I've tried to touch upon and I've covered all the major important concepts. Generally, in a regular batch, which we will be doing in depth, right, which you guys would have ideally done, especially the standard costing, guys. That's very important. I hope you guys have prepared that chart by yourself, right? Anyways, I'll be providing it right now on the the description as well. You will be finding it, right? But anyways, it's better you do these things by yourself. One time investment, that's about it. Your time, I'm talking about your time. One time you invest your time, you will see how beautifully it goes, right? So with this, we have finished this particular chapter, also divisional performance measurement, and with that we come to the conclusion of this particular marathon series for CMA Inter Paper 12 Management Accounting, guys. So now, please trust me, you guys are giving your best. You have given your best, right? So you need not have to worry about anything. Just stay focused on the process. The results will automatically come. So you need not worry about it at all. Now just imagine this level of concepts you have covered. You have spent your time. You guys are so dedicated. If not for you, who will pass, right? Have that confidence in you. Automatically you're halfway through. That's about it. That confidence is all that matters. With this confidence, definitely you are already halfway through. That's about it, right? You can just go and just finish your exam and you'll come out in flying colors, right? So that's it from my side, guys. So thank you all so much, and I will meet you all in CMA final. Bye bye.